And capital flows, and so the market goes back to where it was, and we've seen a little bit of pressure on the Hang Seng, for example. The pound, just checking in on where we are there, 129.12 after the drop of yesterday with that inflation print, of course. And this is the wheat price, up by 1.7% today. Of course, we saw substantial moves higher in wheat and in other soft commodities yesterday. Russia making it clear that they will, adding to pressure on any fleet that is in or around any of the Ukrainian ports, and saying they will be treated like vessels that could be carrying military equipment. And so that has put upward pressure on some of those soft commodities. Let's have a quick look at the futures picture for you. And European equity market futures have looked a little bit softer this morning. That continues to be the case. DAX futures down 0.4%, CAC futures down by 0.3%, and FTSE futures down by 0.1% or so. So markets open across European equities. Let's have a look at where we start today's trade. Looking for a little bit of softness to come through. And yesterday in the United States, we saw actually the banking sector wobbling with those Goldman Sachs numbers. But in the end, the Goldman Sachs share price ended positively. So that's the story around banking of yesterday. We also saw tech overnight being a really dominant theme with the Netflix earnings, the Tesla earnings, something to wonder about when it comes to margins on the auto sector with what's going on at Tesla. And I'll certainly get into that conversation shortly. So how does that all add up to the start of European trade? We also take on board what we've heard from TSMC. Not necessarily much of a European expression of that story, but certainly a fascinating one when it comes to AI, to Chinese growth, to expansion because of geopolitical reasons, of course, around the globe, away from Taiwan into the United States. Tight labor market. That story has everything this morning. So we'll focus on that as well. But the French market then opening weaker, down by 0.4%. The FTSE up 0.1%, in fact, so going its own way a little bit. We see the pound is down another 0.2%. A mixed bag really on currencies, a little bit of softness in the dollar overall and some strength in the euro. In terms of the bond market picture, we see buying of bonds, we see some of those yields coming down, and that really a continuation of the story we saw yesterday around UK inflation. And we see a mixed picture really when it comes to commodities this morning, with iron ore going higher. We mentioned the wheat prices, and certainly that has been a feature of the markets over the last 24 hours or so. Let's have a look at sectors there and see if this gives us any kind of clear picture as to the dominant themes right now. We see the stocks, the energy and basic resource stocks doing a little better this morning. Perhaps that plays strongly for London. So the FTSE 100 up by 0.2% as the result. So you can see commodities is a bit of a theme this morning, and we are seeing some resilience in markets where that is a dominant sector, or at least a large part of the sector makeup. I can see retail pretty unchanged, banks up by 0.3%, utilities up by 0.5%. Elsewhere, we have a fairly mixed bag of sector performance coming through. We've got financial services fairly flat this morning. Travel and leisure actually down by 0.4%. Interesting to see what EasyJet has been saying this morning in terms of the numbers they reported, but crucially in terms of what they say about the summer and how the summer is going to perform. We've seen incredible demand return to that sector, of course. We had a headline across the Bloomberg terminal a few minutes ago that's from the CEO of EasyJet saying he's not seeing the heat, the extreme heat we're seeing in Spain and Italy having an impact on traffic flows, on tourism demand for those locations at this point. You have to wonder whether that continues in years ahead. But at the moment, he is saying that business is pretty resilient. Let's have a look at where we are on the market story then. Sophia Horta-Acosta joins us from our Markets Today blog. And Sophia, let's linger on the China theme, because we've got some earnings happening here in Europe, of course, and that's going to be important. But in terms of that China dynamic, it still lingers in the background as far as a stimulus for or a sentiment driver for the markets. What did you take away from the start of that Chinese story, essentially, as the lights go out on me here in London?
Hi, Anna. I mean, it is a really important story, actually, for Europe. Let's not forget that European markets were the favorite way for traders to kind of play the China story when we did have growth at the start of the year, when there was optimism about the China recovery story. So when we do have, that falling short, pessimism around whether Beijing's policies to support growth and to boost private sector sentiment, concerns over that and really doubts over that, we will see weakness in European equities. I mean, that has been the big play this year because there's so much concern about having direct Chinese equity exposure among international funds. So, the China story is actually, I think, playing more strongly here in Europe than it was when I was covering Hong Kong stocks a few weeks ago. I think that's the most interesting story in terms of macro and what could really derail the risk-on sentiment that we're having since the US CPI print and really kind of reinforced by yesterday's UK CPI print. The narrative in the markets right now, the dominant narrative, is that inflation is peaking and we are getting kind of more focus on growth and whether, what we'll see in kind of the economic outlook going forward. And China could really change the story there, Anna.
Right, and the disinflation, as you point us towards the next part of that conversation then, the disinflation narrative builds, and we're actually seeing on the bond market story a continuation of yesterday's story with those yields coming down, certainly in developed markets. That's the story. As we focus in on maybe a lower peak for interest rates, is that going to linger as a driving theme, do we think, for investors? It seems to be something that, coupled with the soft landing narrative, has really captured the imagination.
Exactly. I think that's exactly the right way to put it, capture the imagination. And the market is almost looking for validation of that narrative. And I think, yesterday's UK CPI print, people were telling me that CPI inflation here is still very high. It's still near 8%. Let's not kind of pop the champagne a bit too early. I think the BOE decision, the next BOE decision will be very important for that narrative. And let's see whether there's a kind of an upward risk revision to inflation. There's still a lot more that needs to be digested on that front. But right now, the market seems to have decided that the disinflation narrative has come to Europe, started in the US, come to Europe, and this is risk on. This is kind of the shift that we're seeing in markets now. Risk on and buy fixed income. We're seeing the jump in yields again today.
Sophia, thank you very much. Thanks for joining us. Sophia Holter-Acosta from the Markets Today blog, helping us understand the early part of the trading day here in Europe. Remember, you can keep across all the stories that the blog team is covering. Go to the Bloomberg UK website. You'll find a link to the Markets Today blog, or you can type TLIV Go onto the Bloomberg terminal. Let's get back to the corporate earnings stories. And Volvo Cars says it expects the profitability of its electric vehicles to improve in the coming months because of lower raw material costs and higher prices for its latest models. This comes after the automaker's second quarter operating income missed estimates due to high lithium costs. Joining us now, Jim Rowan, the CEO of Volvo Cars. Jim, thank you very much for joining us. Let's start right there then with your expectations around profitability for EVs. Do you expect the pressure of higher lithium costs, do you expect that to fade? Is that going to be the driver? Good morning.
Yeah, good morning. Yeah, and nice to join you on the show. Yeah, so what we're seeing right now, we had a very strong quarter. When you look at year over year, our profitability actually increased from 4.6 billion to 6.4 billion over that period. We did signal that we saw the BEV margins were lower than they had been previously, but this was expected because of the high lithium costs. Those lithium prices came in last year. They stayed doggedly high. We took orders in at those high prices, and therefore that was the effect on the margins. Now we see those lithium prices coming back down. Our price increases are now in the market, and so we should see those BEV margins increase, those battery electric vehicle products increase in the third and fourth quarter, and then through the course of 2024, when we introduce new models, which by their design have higher gross margins as well.
Right, okay, so that is helping. You're also saying today that you see your share of the fully electric car sales market above 2022 levels. What's driving that, Jim, and is that sustainable, given everybody else's competing products which come thick and fast in this sector?
Yeah, we were very pleased actually with our growth in fully electric vehicles. So it's got up by 178%, fully electric vehicle sales year over year. Driven really by, I think, first of all, we have the XC40 and the C40. So we only have two models in the market which are fully electric at this point in time. We released a new EX30, which is a smaller SUV. That will be in production at the end of this year. In fact, customers will be sitting behind the wheel of that car in the fourth quarter. And then we also released our EX90, which is our flagship SUV. So we're going to be bringing more electric vehicles into the market over the next few months. And that, I think, will help us take even more market share. So we're bullish for the future that we'll continue to see that growth. Next year, we expect to see that bolstered because of the EX30 will be a high volume SUV for us. And that should take us to the next level of electrification journey.
Can I ask you about supply chain issues, Jim? We heard from Stellantis just earlier this week. They say there's a severe risk of a chip shortage comeback due to a surge in demand. Are you seeing anything similar to that?
No, we don't see that right now. So last year we saw some semiconductor issues and we had to play in the spot market to get those semiconductors, which of course came at a cost. We also had lockdowns caused by COVID last year as well, and by and large, those are gone. What we've done in the intervening 6 or 9 months is that we've really focused on the resilience of our supply chain. We've brought in supply chain analytics tools to help us really much better understand the supply chain dynamics. And at the same time, we've developed linkages directly with those semiconductor manufacturers. So that means we now have direct links with those semiconductor manufacturers, which means we get much more visibility and we can build those relationships. So we don't see that dynamic as something which would be affecting Volvo Cars in the second half of this year.
Can I ask you about pricing? We've seen very, notably Tesla bringing down prices of some of its vehicles to shift inventory there. We've seen Ford cut the prices of its EVs just recently. Are you sticking to your pricing strategy?
Yes, we are. I mean, we've maintained price discipline. We keep a very, very close eye on the market, and with rising inflation, with rising, energy costs, and to some extent, we've seen some reduced consumer sentiment in other parts of the industry. We're in the premium sector, and therefore, I think maybe we're a little bit more protected by that than the mass market sector is. But at this point in time, demand for our products has stayed extremely robust, and therefore we don't see the need to cut pricing.
Do you think that the EU is going to achieve its objective to have no combustion engines by the date that it's set? None of them sold, after 2035. Do you think we're going to get to that? Will that remain the goal, and will we get there?
I sincerely hope so. As you probably know, our actual ambitions is that we will be a fully electric car company by 2030. And in Europe, it's moving incredibly fast in that direction for us as a company. Other parts of the world, I think, will move a little bit slower, but by 2030, our entire fleet will be electric cars globally. I think Europe will be ahead of 2030 for us. So I really hope that they do meet those ambitions, because that's 5 years after we'd like to be there.
Some in Europe have been pushing for counting e-fuels, I think they're called, as something more sustainable than we might have done in the past, and including that in the 2035 targets. What do you make of that?
Well, I think it's a distraction, quite honestly. I mean, I think the e-fuels, you're putting in a charge infrastructure. People are building out that charge infrastructure for electrification at this point in time. That's the direction of the future. If you look at an internal combustion engine, it runs at roughly 30 to 35% efficient. If you look at an electrical propulsion system, it runs at over 90% efficient. So I think we've got to push through, and we've got to move towards electrification as quickly as possible. The other things with the e-fuels, it becomes confusing for the consumer as well. Where can they actually buy those e-fuels? What petrol stations or garages do they go to? Is it going to be in every garage? Will that be universal across the whole of Europe? Whereas charge infrastructure will be universal, and I think it's much more simple for the consumer to understand. I also think it's much better for the environment.
Jim, thanks so much. Thank you very much for joining us. Good to get your perspective. Jim Rowan, the CEO of Volvo Cars. Coming up on the programme, we'll look at some of the stocks that have been on the move this morning. There were plenty to choose from. Joe Easton was taking us through the story at HelloFresh after the company reported its second quarter earnings results. We'll get more on some of those intraday moves just coming up on this programme. Plus, be aware, fans are arriving at the Stadium Australia in Sydney for Australia versus Ireland. That starts at 11 a.m. UK time. We already have one game that's kicked off, I understand, over in New Zealand. But these are fans gathering for the second game of the Women's World Cup as it gets underway in New Zealand and Australia. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Season is here.
A decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back. This is Markets Today. 8:16 in London, 16 minutes into our European trading session, and things look pretty mixed, actually. Well, negative, apart from London, which goes a little higher, up by 0.25%. Let's get a check on the individual stocks on the move. Joe Easton joins us with an update. Joe.
So these are the movers I've got my eye on at the moment, Anna. We're starting with EasyJet. Bit of a letdown in terms of the share price movement, down around 0.3%. Some higher costs and also concern around those strikes over at Gatwick Airport, weighing on the CEO commentary for that one today. Meanwhile, IG Group, the big online trading company, they've seen some resilient client numbers despite concerns that people will start cutting back on online trading due to the cost of living crisis. Meanwhile, HelloFresh getting hit. We saw the chart earlier explaining the pandemic impact continuing to fade. That's what we're seeing in numbers, a big single-digit drop in terms of their client numbers over at HelloFresh. Volvo Cars, the CEO was talking up the prospects for electric vehicles, but the net income is missing expectations, and that one is dropping pretty sharply in Stockholm, down 5%.
That's an interesting one, and I know you've got some further movers for us, Joe, and I'm going to slightly front and run your conclusions by suggesting we're buying cake but not household appliances.
We are indeed. So the cake market is where all the action is today in terms of M&A. Cakebox getting a takeover offer bid from the Cheesecake Shop, according to Sky News. One report I didn't expect to see this morning. But as you say, the white goods market, Electrolux, that's the big drop of the worst performing stock on the stock 600, down around 9%. They've reported a big slump in sales and also will potentially have to sell some assets in order to build up their capital position, according to the company. Now, Publicis over in France, the advertising company, reporting some strong sales, and quite surprising given that we had a warning from Omnicom over in the US just a few days ago, and all of those stocks dropped because of that. Perhaps investors were awaiting some weakness there. ST Micro, I've brought up because of that TSMC report. That's having a bit of a read across, weighing on chip makers. Finally, just a quick look at some of the analyst broker moves today. Morgan Stanley has got a note out on my favourite sector, the alcohol sector. They are upgrading AB InBev. They say that beer companies will see a decline in commodities costs. while they downgrade Pernod Ricard over in the spirit space. That one has rallied a lot recently, so they're taking profits there. Meanwhile, K&S in chemicals, they've got an upgrade at SocGen. A little bit surprising given the weakness in the chemical space. And Naturgy over in Spain getting an upgrade from Exane. Not a single analyst has a buy rating on this stock, but Exane upgrading to hold, and that one rising over in Madrid.
Okay, Joe Easton, he's all about the Pernod, I'm all about the cheesecake. Thanks very much from our equities team with an update on some of those movers. Let's keep an eye on the diary then, things that we're watching out for later today. At midday, we will get the latest interest rate decision from the Turkish Central Bank, which economists expect to continue its aggressive tightening campaign with a 350 basis point hike. 350 basis points. Then at 1:30 p.m. we will get this week's initial jobless claims data out of the United States. It is, of course, Thursday. Before the US market opens, Blackstone will report earnings, capping off a big week in terms of financial services businesses reporting stateside. Later at 3 p.m. we will receive July consumer confidence data from the Euro area. And, of course, the Women's World Cup has now kicked off. The first match between New Zealand and Norway is currently underway, started around 19 minutes ago. The tournament is being hosted by Australia and New Zealand. It's on course to be the most watched Women's World Cup with more than 1.3 million tickets bought in advance. More on that coming up later in the programme. And we've written quite a lot of interesting stories on the pay gap and the push for more broadcasting of this particular tournament and the link between the two, of course. We will return to that theme later. Coming up also on the programme, Tesla drops in late trading after lower car prices squeeze margins at Elon Musk's company. We will bring you the details next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 23 minutes into our European trading day, and the picture for European stocks, well, looks fairly flat, fairly mixed, down 0.1% on European stocks overall. The FTSE outperforms a little thanks to basic resources. Now, Tesla shares slumped in late trade after profitability shrank in the second quarter, and the car maker warned hits to margins are likely to keep coming. Elon Musk said the company will probably keep lowering the prices of its electric vehicles if interest rates continue to rise. Months of markdowns have already taken a toll on Tesla's gross margin, which fell to a 3-year low. Let's turn to other earnings stories. And Netflix shares have slumped as much as 8% in after-hours trading following projected third-quarter revenue that fell short of expectations. The earnings suggesting a crackdown on password sharing and a new advertising tier aren't yet delivering the growth analysts anticipated. Here with more details, Bloomberg's Olivia Solon, who can take us through some of the conclusions from this earnings story. So talk us through the earnings then from Netflix here, Olivia.
Right, so as you said, revenue growth was slightly lower than analysts expected, but I think on the other side, their subscribers increased enormously. They gained, I think, 6 million subscribers in this last quarter. Analysts had predicted maybe 2 million, and this is down to this kind of quite aggressive crackdown on password sharing. So now it's rolled out this detection technology that picks up when someone's using someone else's account in another household, and then they're trying to push the original subscriber to either pay a small additional fee to allow that person to continue using their account or to get the other household to pay. And on top of that, they've also introduced this much cheaper ad-supported tier of membership, which seems to be showing early signs of success. But the key message from Netflix was, hold on, this is a new, these are new initiatives. The impact's going to be felt further down the line.
Right, yeah, so it's a sort of timing issue, is it? Because both of those stories sound positive in terms of the bottom line at Netflix, but what, they're just not delivering in the short term?
Well, you've got to remember that shares are up 60% this year so far. So, yeah, that took a hit yesterday in late trading, but they seem to have recovered slightly overnight. So, yeah, they just say wait and see. Q2 was the first quarter in which the US had this password crackdown. Its biggest market. So, yeah, they said that, yeah, wait and see.
That's working quite well then, is it, the password crackdown?
It looks like it, despite some skepticism initially.
Yeah, because they tested it in other geographies first?
I think Portugal and Canada and various other places, they started in February, and then it took until late May to launch in the US.
Okay, interesting. Olivia, thank you very much. Thanks for joining us. Bloomberg's Olivia Solon with the latest on the Netflix story. I can tell you that NASDAQ futures are down by 0.7%, and that has a lot to do with some of those after-hours news stories that we were talking about. So we've taken you through the Tesla story, just talking with Olivia there about the Netflix story, and all of that having a negative impact on the picture for NASDAQ futures. On the GMM then, you can see quite a mixed picture really for global stocks right now. The Stock 600 down 0.1%. The FTSE 100 up by 0.4%. In the FX markets, we've seen the Australian dollar catching a boost, maybe from some of those policy changes in China, maybe to do, we've seen a lot of movement in the Chinese currency as well. Some of that optimism around Chinese policy change, it seemed pretty short-lived. The market thought about it for a while and decided it wasn't so enthusiastic about Hong Kong stocks. And certainly Hang Seng down by 0.2% by the close. Commodities really in focus after we've seen quite a lot of news flow surrounding wheat and the war, of course, in Ukraine. More on that shortly. We'll also talk about FX markets. The pound took a tumble after UK inflation came in cooler than expected during yesterday's session. We'll get more on the FX trades. That's coming up. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is It actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. The yuan jumps after China ramps up support for the currency and eases capital curbs. European and Asian stocks are mixed. Two key TSMC equipment suppliers slump at the open as Apple and Nvidia's main chip maker warns sales for the full year will decline more than forecast and pushes back the start of production in Arizona. Plus, Tesla price cuts drive down margins while Netflix dims forecasts. Both stocks slump in after-hours trade. Welcome back to the program, everybody. Let's have a quick check on where we are on the markets. And as we said just before the break, things are fairly flat, really, across the European session. So the Stoxx 600 down by 0.1%. The DAX is a little bit weaker, the FTSE a little bit stronger. And some of that has to do with the sector breakdowns of the two, and the fact that we have energy and basic resource stocks, of course, listed in London, plays to its favour on a day when those sectors are doing not too badly. In fact, basic resources, the best performing sector this morning, up by 1.1%. We also have insurance, utilities doing pretty well, fairly mixed bag, actually. Around 2/3 of sectors moving higher, around 1/3 to the downside. Technology, the worst performing sector. No surprise, given the weakness in that TSMC forecast and all of the news flow surrounding TSMC. That seems to be weighing on some of the businesses that are attached, as we said in our headlines, to TSMC. Let's get a check on some of the individual stocks that are on the move this morning. Joe Easton has a look at, tragically, I think, some of the losers, Joe.
Exactly, so we'll take a look at the losers first down, and the big one, Electrolux over in Stockholm, getting absolutely slammed down around 11%. They may have to raise around $1 billion worth of capital due to a slowdown in sales, according to the company today. Meanwhile, HelloFresh in Germany down 5%, a continued slump in client users following the ending of the pandemic, obviously, which was the big decline on those sales there. ASMI, you mentioned there in the build-up with TSMC, that warning really hitting a number of chip makers and chip machinery companies. That's one of the worst performing tech stocks today, down 5%. We mentioned Volvo Cars earlier, a lot of the focus on EVs, electric vehicles, how that's progressing, and the CEO was very bullish on that, but the net income is not what analysts expected, and they are thinking that could continue decline throughout the second half of this year as well. We'll also take a look at some of the gainers today as well. The most interesting one for me is Hikma. This is in London, up 8%. It's a generic pharmaceutical company. Now, there's a plant over in the US run by Pfizer, which has been taken out by a tornado, according to reports overnight. And Hikma actually makes some products that might actually come in and fill in some of those supply gaps, according to analysts today. And that's rising around 9% in London. Meanwhile, Publicis, mentioned earlier, that one getting a boost. Strong sales. There is concern around advertising slowing down as the economy does weaken. We saw that from Omnicom over in the US just a few days ago, but Publicis not seeing signs of that, very upbeat on their outlook. Meanwhile, in chemicals, K&S in Germany, they've got an upgrade at SocGen, rising around 4% for that one. Not many analysts bullish on the chemical space at the moment, given the profit warnings we've seen there, but that one doing pretty well. Finally, IG Group, the big retail trading company, lots of adverts for this online, and it is seeing an increase actually in some of their active user numbers. That's expected to have declined, but they are not reporting that. A bit of a contrarian view there from them, saying that they do think people will continue to trade and invest during the cost of living crisis. So IG rising in London.
Okay, thanks very much, Joe Easton, with a look at the losers and gainers then on these markets this morning. Thanks to Joe Easton for that. Let's have a quick recap of the adventure that has been FX markets over the last couple of weeks or so. And certainly the CPI data out of the United States stands out last week as well. Potentially a game changer. It certainly had an impact on the day and continues to have an impact on all the notes I receive in my inbox about dollar weakness. So a lot of people talking about how much weaker the dollar gets from here as a result of the victory to some degree around inflation. There's a UK expression of this, of course. We saw the inflation data out yesterday from the UK, came in lower than had been expected. That weighed on the pound, but how do those two trends fit together? That's just part of what the FX markets is dealing with right now. Let's get to Sam Zeef, head of global FX strategy at JP Morgan Private Bank. And Sam, let's start with your sort of big picture, global view around the dollar. Are you in that camp that suggests that this was quite a game changer last week, and actually the dollar is reinvigorated to the downside as a result?
We are in that camp. I do think that the US CPI print was a bit of a narrative changer. If you think about the Fed's super core measure, what Chair Powell has identified himself as the real part of the CPI basket they care about, core services ex shelter, on a 3-month annualized basis, it's running below 2%. So it does seem like the Fed has gotten the majority of the inflation problem under control, let's say. But we try and do separate between, well, what are the criteria for a pause and what's the criteria for a cut? Right? Criteria for a pause, we think we're just about there, and that should remove a lot of that interest rate support from the dollar that it's been getting. Cuts, whole different story. Fed needs to see weaker labor markets. It needs to see initial jobless claims ticking higher. But we do think that this should allow for the next leg of dollar weakness that we should get for the second half of the year. Okay, we get initial jobless claims today, don't we, of course, it being Thursday. How long a pause, then? I suppose that's crucial to the dollar view as well. Yeah, I mean, again, it will depend on what we see in the labor market. I think they're prepared to kind of sit at these levels. Maybe there's 1 or 2 more hikes. We do think there's a hike coming at least next week. But they could sit there for 6 months. They've done that before, right? I think it will really come down to when do they finally start to feel confident that there's enough weakness coming through, or let's not even call it weakness, loosening of the labor market. The main thing for us, though, is the data that we've gotten over the last few months suggests that the pain in the labor market that they need to engineer to feel comfortable that they've gotten the inflation issue under control is less. And that's a good thing, right? But that tends to be good for risk sentiment, tends to be decent for global growth, and not as great for the dollar. Do you think that the Fed should be more worried about over-tightening or under-tightening? We had an interesting conversation last hour about this with one of our guests, and I just wanted to get your perspective on that debate, I suppose. Yeah. Well, look, I used to work in the building. I'm speaking with bias here. The Fed knows that it is very easy to lose inflation fighting credibility, and it's very hard to get it back. So I am of that group, even as I see them approaching a pause. I'm on this more dovish side probably when it comes to the Fed outlook, but I agree with them. The risks of doing too much are lower than the risks of doing too little. So at the Fed, they're on the side of caution. They're risk managers.
Yeah, and to sort of maybe over-tighten.
If they had to choose.
If they had to choose.
Yes.
Okay, and so if you're looking at the FX markets and you are expecting the dollar to go weaker, then against what? What do you trade it against?
Yeah, our kind of core conviction has been this is a narrow dollar weaker environment. We're still looking at slowing below trend growth, risk sentiment. We think could be a little better in the second half of the year, but it's going to be volatile. That type of environment, or do you want to be short dollars against what we call the alternative reserve currencies? Euro, Swiss franc, gold, currencies that are less sensitive to global growth and global risk sentiment, and most sensitive to that interest rate differential potentially between the US and other economies converging. That's really where we want to focus that and where we would continue to.
And we've seen a lot of action from the PBOC in recent days, really trying to protect their currency. How does that rub up against a weaker dollar vibe?
Yeah. So the RMB, these measures that we see being taken are yuan stabilizing measures rather than something that's going to engineer yuan weakness, or yuan strength, let's say, in our minds. China's facing more structural balance of payments issues. There's a lack of FDI inflows. There's not a lot of portfolio inflows either. And of course, being long the RMB is very negative carry still. That interest rate differential between the RMB and other Western economies is still very, very wide. But if there's stability, that's a good thing, right? And that will allow other currencies that are very heavily tied to the RMB, Australian dollar is one of them, to maybe get a little bit of a break here and also participate in some of that dollar weaker trend.
So the dollar weakness trend, thinking about how that goes global, how does that rub up against the BOJ dynamic right now? Because we're waiting to hear from the BOJ. There has been some expectation, I mean, the sort of background expectation all the time that the BOJ will shift policy, but it doesn't happen.
It's always there.
So it always seems to be, you know, to some degree people's expectation. So Sam, how does that play out with a weaker dollar?
So dollar yen, incredibly difficult to call, incredibly difficult to trade, very easy to model. It is just interest rate differentials. Our view over the next 12 to 24 months, let's just even put the BOJ aside, is that global yields, as global inflation comes down, as global growth slows, peak and start to converge towards those in Japan. And that should be yen supportive over the medium term. Now, when to put that trade on with such negative carry that being long the yen has is very difficult to trade. But over the medium term, we do feel quite confident that dollar yen and really anything against the yen should go down.
I suppose timing of both of those on the yuan and on the yen becomes really interesting, doesn't it? Because you might have a change in direction from a central bank, but interest rate differentials may still exist and be wide.
Exactly. I mean, if we, again, 12 to 24 months is an easy thing to call that dollar yen, let's say, should go down. When to really put that trade on, it probably is maybe more of a 2024 story than a second half of 2023 story.
And when I was asking you about how you trade weak dollar, you mentioned the euro and those other sort of currencies that you called them second tier
alternative reserve
currencies. So where does the euro get to with that in mind?
Yeah, so we've been long held kind of euro bulls. I hate to call it a bullish stance, but we think that euro dollar should go to 115. Top end of that range is probably 117. That's easy to say now, but we were saying that when euro dollar was down at 105.
Right. Why do you not like the word bull? Just because we're at 111, well, therefore it's not that bullish.
Exactly. It's not that bullish. And also, when you say euro bull, it makes you think like you'll always be euro bullish.
Right.
But we take a cyclical view of this. If we get up towards the top end of those ranges, maybe we'll become a bit more balanced and think about the other way.
Okay, if the data changes, Sam.
Exactly. We can
change your mind. Sam, thanks very much for joining us. Sam Zeef, Head of Global FX Strategy at JP Morgan Private Bank. Now, for something different, the Women's Football World Cup has kicked off today with the first match between New Zealand and Norway underway. It is currently, drumroll, 0-0, but it is playing to sold-out stadiums, this World Cup, and a TV audience in the billions is expected for the tournament. It's being hosted by Australia and New Zealand. Bloomberg's Paul Allen reports.
Final touches are being applied to this fan zone in Sydney's Darling Harbour for the Women's Football World Cup. The month-long event is expected to deliver a welcome boost to tourism after some tough years during the pandemic.
So why not come and take a day?
You shouldn't underestimate the power of football globally, and there is just a whole legion of fans out there, and those fans also are high-yielding travellers often, so it's a real opportunity for Australia, not just for the tourism industry, but for the overall Australian economy.
On the pitch, the powerhouse US team is widely picked to win a third straight title, their fifth overall. Australia will be looking to go as deep as possible into its home tournament after defeating world number 5 France in their final warm-up match.
Of course, most fans won't be either in a stadium or a fan zone like this, but we'll be watching the games on TV. And that's presented something of a problem for FIFA. Despite the growing popularity of the women's game, football's world governing body is unhappy with some of the low-ball offers it's been getting for broadcast rights.
A blackout of the tournament was narrowly avoided in Europe after a deal was reached at the last minute. The terms of that deal remain secret, but it's understood bids have been just a fraction of what was paid for the rights to last year's men's edition in Qatar. The revenue shortfall isn't helping the desire to achieve prize money parity in the men's and women's World Cups. A total of $440 million in prize money was on offer at last year's men's tournament. At this year's women's tournament, the prize pool is $110 million. Australia's footballers are among those calling out the disparity.
FIFA will still only offer women 1/4 as much prize money as men for the same achievement.
The FIFA Museum in the fan zone is dedicated to the great moments in past Women's World Cups. 20 years ago, there was no prize money at all, but achieving prize money parity will mean FIFA getting substantially more for broadcasting rights in 2027. Paul Allen, Bloomberg, Sydney.
A really interesting report there then as the Women's World Cup gets underway in Australia and New Zealand. Coming up on the programme, we'll get some detailed reporting on what's going on in the soft commodities market. Wheat has its biggest daily surge in a decade as Russia threatens ships sailing to Ukrainian ports. We'll bring you the latest next. This is Bloomberg.
you think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today, 45 minutes into our European trading session, and European stocks flat to positive this morning. Let's talk about soft commodities. Wheat had its biggest daily surge in a decade yesterday as Moscow threatens ships sailing to Ukrainian ports. This comes after Russia's withdrawal from the Black Sea grain deal. Joining us now for more is Bloomberg's Kira Wright, who's in Sydney and tracking this soft commodity story. So, Kira, what are the details around Russia's threat to cargo ships?
Yeah, thank you for having me here today. So I guess Russia has resumed blocking ships into some of Ukraine's biggest export destinations, so some of its biggest key ports. The Russian Defense Ministry actually issued a warning saying that they were going to classify any ships that were heading into the Ukrainian ports to be potentially carrying military cargo. So that one comes into effect as of today, so Thursday. Now, Ukrainian officials have basically said that this is just Russia's attempt to try and, I guess, bring food into their ongoing military conflict. Meanwhile, the US is saying that it's just an excuse to be able to launch attacks on some of the civilian ships going through the Black Sea and then blame it on Ukraine.
Okay, and what impact is this surge in wheat prices having elsewhere? And to put it in context, I mean, the biggest surge in a decade, which is incredible when you think about the start of the war, and this being bigger than that.
Yeah, that's right. I guess we saw movement of price futures for wheat rise about 9% yesterday. We saw those gains extend today. And it's a very good question in terms of impact, one I think a lot of traders but also consumers kind of have on their mind. Obviously, wheat is a very big part of a lot of people's diets, and it's probably premature at this point to kind of comment on whether or not it's going to have any lasting prices on food inflation. But what I can say is that a lot of products made out of wheat, so your cereal and your flour, they did kind of have these prices continue to climb even when the prices of wheat were significantly lower than what we've seen these last 2 days. So we certainly could see kind of prices for food manufacturers rise again.
And Kira, what does the collapse of the Black Sea grain deal mean in the longer term? Clearly, this is how it's playing out in a very real sense on the water in Ukrainian ports, and we see the geopolitical threats that exist as a result. But what does this mean longer term?
Yeah, look, I mean, it definitely jeopardizes a very key trading kind of route for Ukraine, which is significant because Ukraine is one of the biggest exporters of grain and also vegetable oils in the world. Now, what we're going to probably see is that Ukrainian grain production is going to instead be pushed to a lot of its river ports plus rail and road and for transit over the EU border. For Ukrainian exporters, though, I think that what we're going to see here, the biggest challenge being is increased prices prices, because obviously the further that the grain travels, the higher the price is for those exporters.
Okay, Kira, thanks very much for the update. Bloomberg's Kira Wright joining us with the latest on wheat prices and the broader knock-on impacts to other soft commodities. Coming up, we'll get back to corporate earnings, and Goldman Sachs profit plunged as the Wall Street giant notched up one of its weakest quarters under the CEO, David Solomon. We'll get more on the US bank earnings reporting season next. This is Bloomberg.
Steve's ability on the course may not be etched into ending record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today, 8:52 in London, 9:52 in Paris and Berlin, and we see a flat picture really for European stocks. London outperforms today, but the CAC 40 in Paris also up a little, up by 0.2%. Let's delve into the bank earnings. Goldman Sachs profits plunged as the Wall Street giant notched up one of its weakest quarters under the CEO, David Solomon. Shares initially fell before making gains as Solomon moved to strike a more hopeful tone for the months ahead.
We are making tough decisions that are driving the strategic evolution of the firm. Given both these factors, it should come as no surprise that we're going through a period of lower results. I remain fully confident that we will deliver on our through-the-cycle targets of mid-teens returns and create significant value for shareholders.
For more, I'm joined by Bloomberg Markets reporter Valerie Teitel, who's been looking at the bank's story. Valerie, good morning. So take us through the Goldman results. What stood out to you?
Well, first off, their second quarter profit plunged 58%, and the return on equity slid to 4%. Anna, that's the worst now among the major U.S. banks. And they were the only U.S. banks out of the major six to be a miss on earnings per share. This is even despite Goldman being out in the last few weeks, really trying to downplay this earnings season for them. Going into this earnings season, even analysts slashed their estimates for EPS by almost half. So still a miss on EPS, even though they did downplay that. A lot of this is a part of their continuing strive to restructure their balance sheet, to get less capital intensive, and to move to more alternative asset management models, fee-based models, and really exit those non-core businesses, which came at a cost. They had a very large equity investment write-down, a very large commercial real estate write-down, which did drag on their bottom line. But there were some bright spots in this, Anna. Their equity underwriting fees came in better than expected. Their equity trading fees also came in better than expected, and actually better than Morgan Stanley, who is known as the equity trading house on the street. Overall overall trading generally was down 15%, and that's a lot better than what the president guided us for only a few weeks ago, said it was going to be down 25%. So that, and then the optimism from the CEO in the earnings call led the stock to end in the green at the end of the day.
Okay, what a difference a quarter makes. This time last quarter, we've been talking a lot about regional banks and the difficulties they'd faced. What's the story been so far? They haven't been grabbing the headlines in quite the same way, which probably is a good thing.
Probably a good thing. Yes, we've heard from some of the big ones, Western Alliance, Citizens, U.S. Bank Corp, and there is a theme of net interest margin compression. These regional banks are having to pay up more for their deposits, causing their cost of capital to increase. That's really eating into their margins when it comes to net interest income. They've also been shrinking their balance sheets, which is the theme we've seen all quarter. They're trying to divest some of their loans, trying to exit some of their businesses which aren't as profitable, and this is for two reasons. One of which, their cost of funding is increasing as they're paying for deposits, and secondly, they're just getting ready for this capital overhaul that's coming out of regulators, expected to be announced next week. And these capital increases, they're already setting aside money for that, trying to increase their capital ratios, their common Tier 1 equity ratios, in order to get ready for this sweeping regulatory overhaul.
Valerie, thanks very much. A focus on regulation then for those smaller banks. Valerie Teitel with the latest on the banking sector. Just before the break, we were talking about soft commodities and the impact that the breakdown of that soft commodities deal between, brokered by Turkey that Russia had with Ukraine through the United Nations, the breakdown of that deal, what that meant for the prices of various soft commodities. And just on that note, we're hearing now from Kernel Holdings, which is Ukraine's largest sunflower oil producer. The company is saying that it may take at least 12 months to restore its facilities at the Chornomorsk port in Ukraine after it was hit by a Russian attack on July the 19th. They're talking about infrastructure damage, but also a fire that partially destroyed 60,000 tons of grain. As a result of that, they're talking about the risk that global sunflower prices or oil prices go higher. We've seen soft commodity prices generally a lot higher, an 8% increase in wheat prices just yesterday, and that continues today with an increase of around 2% on the back of that changing stance from Russia and the breakdown of that deal. Russia talking about treating fleet in the area as potentially carrying weaponry, and we have seen some of the tragic results. This is Bloomberg.
Adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap. as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The yuan jumps after China ramps up support for the currency and eases capital curbs. European stocks slide as Apple and Nvidia's main chip maker, TSMC, warns sales for the full year will decline more than forecast. Plus, Tesla prices cuts drive down margins, while Netflix dims forecast will bring you any pre-market moves over the coming hour. Now, first thing is first, let's take a look at the European markets map. Now, a lot of these equities, of course, are driven by what's happening in technology and chip makers in general. Now, we're holding on to some gains. The DAX gaining some 1/10%, the CAC 40 over in France 0.3% higher, but really the main focus is what's happening in chips. Now, despite the fact that AI is still in a boom, we saw TSMC, the Taiwanese chip semiconductor maker, saying they're expecting demand to fall some 10%. That's having a ripple effect. So ASML, one of the biggest losers in today's trading session. Three charts very quickly to really wrap up and encapsulate the main stories today. First of all is one of yuan. This is after China actually stepped up its support for the managed currency with a stronger than expected reference rate. They also changed some of the capital rules to allow more inflows. We love looking at China because if there's one thing that you have to get right in this market is actually trying to understand the Chinese economy and the impact and ripple this has to the rest of the world. Two other stories that we need to watch out for is earnings. Look, we've had many earnings calls. I know today we had, for example, two ones that were worse than expected. This is Netflix and, of course, Tesla. But overall, 82% of companies that have reported were better than expected. S&P 500, 12% of those companies have reported so far. And then next week is going to be a crazy week. If you actually look at the number of companies reporting, $25 trillion worth of companies will come out and report, and most of those are in the U.S. So a lot of them will be in the S&P 500. So it's a very big week. Happy Thursday, everyone. I would suggest you have a nice and relaxing weekend to get you started for next Monday. Now, joining us to talk, of course, about earnings, to talk about China, to talk about inflation is Invesco Global Head of Asset Allocation, Paul Jackson. Paul, I hope you have a restful weekend because it is going to be quite busy next week. When you look at earnings, they're not doing too badly, but then you look at chips and you think, actually, we're in the midst of an AI boom, but we have to reprice everything. What do you worry about the most?
I think for me, the biggest concern is the slowdown in the global economy, which has a knock-on effect on profits in general. To be fair, profits have done a lot better than I would have imagined in the last year, but we are seeing that slowdown come through. And I think stock markets in particular are not reflecting what's happening in the global economy. So for me, the biggest worry for the second half is that there is a bit of an awakening in the stock market and we get some correction coming through.
So let's look at the positives and the negatives. The positives is that actually there does seem to be around the world data that shows that we could be seeing peak inflation, that from now it's going to get on. So that's a positive. A negative, would you put China?
No, actually, I look at China as being more of a positive, to tell you the truth. You've got a central bank that continues to ease, an economy that was effectively in recession last year and coming out of that. If you look at just something very simple like money supply growth, Chinese money supply growth is continuing to rise, whereas in the US it is actually negative. So I would expect better economic momentum from China, where inflation is actually very low. So I think China is at a very different stage in the cycle.
Yeah, and I keep on hearing, look, we're importing deflation from China. Does that make it easier or harder for central banks?
I would guess that makes it easier. And I think importing deflation, that sounds a bit of a strong term to me. It's maybe putting too much weighting on this. But at the end of the day, there are pockets of inflation in the world. Most of the world suffered inflation last year. China did not. And to the extent that it can dampen inflation elsewhere, then yes, that does help central banks.
But so when you say you worry about the economy, what do you worry about the most? So is it again the fact that central banks have to almost crush the economies to get inflation under control, or is it economic divisions?
I think it is that I think the central banks have just about done enough, especially in the States, but that perhaps they're going too far. But we've already seen that investment spending has weakened 4 quarters in a row in the US. The consumer is losing momentum. So it's just natural that the economy is going to slow down and perhaps go into recession. It's a part of the process. And yes, when central banks tighten, they do want economies to slow down.
All right, Paul, hold that thought, because, I mean, you came on a really busy day. Congratulations. You won the jackpot. We talk earnings, we talk companies. So Paul Jackson stays with us. Let's also go on to what we heard from Tesla. This is the EV maker, and shares falling in late trading yesterday. They're currently, well, down significantly, I think, if we have that pre-market. Profitability shrank in the second quarter as prices cut, of course, hit margins, and that stock pre-market down 3.6%. So joining us for more is Bloomberg's Ollie Quirk in Berlin. So Tesla earnings, Ollie, what do we need to care about? I mean, they just disappointed, really.
Yeah, I mean, they beat on some estimates, but the thing that everyone was watching was the margin, because this is a story of market share versus margin. So they've cut prices on their top models by 30% since the end of last year. And the margin, that is what everyone was watching for in this earning report. Gross margin in at 18.2%. That was a miss. Now, that's not a terrible margin for a car maker. A lot of these EV legacy car makers that are making EVs are actually losing money on each single EV they sell. However, if you go back 4 or 5 quarters, that number was closer to 30%. So it's really eating in at the margin. And Elon Musk on the call said, hey, we will cut more if we need to. So the question is this working? In the first half of this year, the Model Y was the best-selling car in all of Europe. We got the June numbers yesterday. Tesla outsold Citroën and Fiat in their local market, and that's across the spectrum. So that's all positive. So in that way, it is working. However, the problem that Tesla now has is it's building up inventory. And the investors gave up their verdict, down 5%, but up 130% this year. So who cares? And the last point that we make, this week we saw the Cybertruck roll off the assembly line. You'll remember, Francine, that video from 4 years ago when they unveiled this bizarre-looking car testing the shatterproof glass, which of course shattered on stage publicly. However, they are beginning to actually put these out into the market. It looks like at the end of this year, but more probably next year. So you might start to see them on the road.
Yeah, I quite like them, actually. I think if you're cool, you like them. If you're a bit more traditional, maybe you'd rather buy something else. Ollie, thanks so much. Oliver Quirk there on the latest with Tesla. Now, Paul, if you look at Tesla, and I don't know whether this is, a story of Elon Musk, which, of course, he's kind of, the man of the hour, in good or bad, or whether this is one of EVs, of greening the economy and batteries, and so how that fits into your macroeconomic view.
I think Elon Musk as an individual has had a massive effect on the way that the auto industry is valued within the stock market. If you look today at the price that the stock market is paying per car sold, and I'm talking globally, not just one company, but the price the stock market is paying per car sold is 2, 3, maybe 4 times what it was pre-pandemic. And so for me, there is a a big Elon Musk effect there in that there's a certain spin that is being put upon this, and we're paying a lot more for auto manufacturers than we used to do. And as far as I'm aware, they're not any more profitable than they used to be. So I'm a bit skeptical about the valuation of this sector in general.
That's fascinating. But in general, I mean, I know you see the biggest risk that, stock markets have looked too far ahead, and you actually see value in Chinese stocks. First of all, how do you play China?
I mean, for me, it's a broad-based approach. I think with an economy that is improving and with valuations the way that they are, I think you can be fairly broad in your approach. Usually for an economy that is recovering, you would maybe focus more on the smaller, medium-sized companies, more on the value end of the spectrum. But even if you look at, say, the technology sector, I think that you can play or invest in technology stocks in China at a much better valuation than in the US, for example.
I mean, do they feel like they're in a bubble in the US? I know we're seeing a lot of pressure today on some of the chip makers. Are they priced to perfection?
I think in some segments, perhaps, and we've seen the AI craze that has taken off this year, and I think that is a massive bubble in the making, but credit conditions around the world are not such at the moment that you would expect to see a big bubble build up. But I think that is one specific area perhaps where there is. And the problem with chip makers is that it's one of the most cyclical industries. And if the global economy is weakening, they are going to suffer on the back of a bubble a couple of years ago when there were massive shortages. And this is a sector that goes from abundance to shortage, abundance, and the capital spending cycles are pretty abrupt. And I think they're suffering at the moment from overinvestment.
Paul, thank you so much. Of course, Global Head of Asset Allocation, Paul Jackson, stays with us. We'll talk a lot more about technology and also this difference between, I guess, macroeconomic fundamentals and what the market is pricing in. Coming up, left buffering, Netflix slumping pre-market after projections for third quarter revenue fell short. We'll have more on that next, and this is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
So welcome back to the Pulse. Now, Netflix slumping pre-market this morning after projections for third quarter revenue fell short of expectations. Now, the earnings suggested a crackdown on password sharing This is my favorite story. And the new advertising tier are not yet delivering the growth that analysts had anticipated. Well, joining us now is, again, Paul Jackson. Thank you for staying, Paul. Global Head of Asset Allocation at Invesco and Bloomberg's Olivia Solon, who's our team leader for all of our tech stories. So, Olivia, first, I love this, right? Because I do have, and it's a younger population that usually say, oh, I can't watch Netflix anymore because I can't use my family's password. So Netflix basically thought we're going to crack down and they're going to buy subscriptions.
Right, so Netflix estimated about 100 million people were sharing passwords and not paying for a subscription. Yeah. So yeah, they'd rolled out this new technology to detect when people were doing that and then try and force the households that were sharing their passwords to either pay an additional fee to cover the cost of the other household or to force that other household to pay for their own account.
So is it not working because we watch TV less because now we're all out having drinks because it's no longer lockdown? Or is there a pricing issue, or is it a timing issue?
So it actually is working, which is the interesting thing. In the last quarter earnings, we saw that the subscriptions were up by 6 million, which was like way more than anticipated. But I think what's not working is they haven't quite figured out how to turn that, into as much profit as was anticipated.
I mean, Paul never shared a password. It's just not. It's just not your style.
Of course not.
But Paul, I wonder whether this goes to kind of consumer behavior and how it's difficult to see how it's changed pre and post COVID because everything's a bit of a muddle right now.
Yeah, I mean, first of all, from personal experience, I move all around and watch Netflix and other providers from different places in the world, and I think it's very difficult for them to really crack down on this, and different people in the same household with different email addresses. I don't know exactly how they enforce this, but for sure I think streaming in general is a lot more popular than it was, but there's such a proliferation of streaming channels now. There's so much choice out there that I think young people in particular are probably having to be quite selective in terms of what they will pay for and what they will not pay for, and maybe that's the monetization problem that is being faced here.
So, but do you think also this is a cost of living crisis? I mean, we're also seeing people going back to the cinema. I mean, tomorrow I'm quite excited. There's the Oppenheimer Barbie kind of not rival, but friendship.
I'm going to see Mission Impossible tomorrow.
Okay, you're outside. We can't count you as the data of seeing double films, but a lot of younger people now go back to the cinema. How does that impact consumer spending for recreational activities?
Well, first of all, I was shocked how much it costs to go to the cinema now. I'm shocked at how much I'm having to pay tomorrow, which again shows that I haven't been to the cinema for a few years. But absolutely, when people are struggling to make ends meet, to feed the family, putting food on the table and heating the home, or air conditioning now, these are luxuries that we're talking about, going to the cinema and paying for TV. So I think it absolutely does squeeze. We saw that with Netflix, where a few quarters ago, sometime last year, they had a quarter that was really very difficult in terms of lost subscriptions. And I think that really was down to the cost of living crisis.
And so, Olivia, the other thing, I mean, I'm fascinated by, I know you cover with the team, is basically these chips. So we talked a little bit about it earlier, and I don't understand. So there's the AI boom. Everybody needs to upgrade. There's these new generational chips that come out probably every 12 to 18 months. But then you have, the Taiwanese semiconductor saying, look, profit's going to go down 10%.
Right, so I think the economic recovery that everyone is expecting after the post-pandemic slump has been a lot slower than expected, including in China, and that's been an issue for these companies. Then there's also the geopolitical issues related to China, which for TSMC is an issue for its manufacturing, although it has diversified its manufacturing footprint.
Yeah, so it's something that, of course, we'll keep on watching. Paul was saying parts of the market could be in a bubble. We'll get to that a little bit later on as well. Bloomberg's Olivia Solon, Paul Jackson, Global Head of Asset Allocation at Invesco, stays with us because we need to talk about banks next. Coming up, Goldman Sachs' second quarter profit tumbles. We discuss what led to one of the worst quarters for the bank under the chief executive, David Sullivan. That's next, and this is Bloomberg.
Okay, so you're moving in on me, quick. Distracting me with your fancy hands. I'm going to deal with your knight, because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Now, Goldman Sachs' profits plunged as the Wall Street giant notched one of its weakest quarters under the chief executive, David Solomon. Now, shares initially fell before making gains as Solomon moved to strike a more hopeful tone for the months ahead. Now, for more, we're joined by Andre Jansen van Vuren from our finance team. Still with us, Paul Jackson, Global Head of Asset Allocation at Invesco. So thank you for sticking around. Andre, when you look at the takeaways, I mean, Goldman Sachs and Solomon had been guiding down, so the market weren't expecting many good results. So is it all plain sailing now that they've guided lower and actually they see green shoots?
Morning, Francine. Well, that's a question that remains out there. It's, as you say, they've actively guided the earnings down for the quarter. In the markets have seen a lot of things that they expected to be there. For instance, the investment banking slump, the write down on the goodwill for the Green Sky business that Investor inspected, but there's still a lot to remain. There's still questions over what will happen next with the Green Sky business. Are there more goodwill to be write down there? We are still in this trial on investment banking. It depends on whether activity in that sector will pick up, on where Goldman goes from here.
And so, Andre, I mean, overall, so we've had the big banks report, we have some of the smaller. We're expecting, of course, an overhaul in terms of regulation. I mean, is the earnings season really helping some of the U.S. banks to move on from the turmoil that we saw 5-6 months ago? Again, overall, does it feel like we're over the worst?
I think for the broad sector, there is hope. We see markets, you know, for instance, with Goldman, in that case, exact after yesterday, shares were up, largely unchanged for the rest of for the year so far. There are still these, despite optimism, there are still these questions about, you know, what will the deals environment do? What's going to be happening on rates? So I think on the balance, slight optimism, but there's still also a lot of caution.
Yeah, quite a lot of caution. And of course, Paul, they kind of track the economy, but not that much. It depends. Like, I don't know whether there's any value in European banks or whether you just make a regional differential because they're valued differently. If you look at earnings per share, if you look at also some of the income ratio.
Well, the first thing I would say is that usually when stock markets are recovering the way that they have been, you would expect banks to be in the forefront of that. You know, so they're usually early cyclicals. Hasn't happened this time, and it's this disconnect between the market and the economy that I think is going on, and the banks are really at the center of that. But banks, you would expect overall default rates to be going up at this stage in the economic cycle. There's been volatility in markets, so it's natural that you get less IPO and M&A activity. That activity, though, I would think with markets improving, would start to come back. But the default problem for commercial banks is going to be an issue. And the steep inversion of the yield curve is not good for banks if they're arbitraging the yield curve.
But so when you look at defaults, and we haven't really seen this like worst case scenario that we had talked about when interest rates started creeping up, is it because a lot of the risk has moved to shadow banking, the unregulated part of finance?
I mean, I think it's slow to come through, but if you think about whether you're looking at the high yield market, whether you're looking at the bank loans market, you can see that default rates that were starting from extremely low levels are now climbing up. And I think you will start to see that having an impact on the banking sector. There is a lot of zombie companies still out there after the pandemic, and I think a lot of that will be shaken out if we get much more slow growth and recession.
All right, thank you both for joining us. Andre Jansen, Van Vuren, our finance team, of course, here in London. Paul Jackson, Global Head of Asset Allocation at Invesco. Now, coming up, we have, of course, Bloomberg UK, and today we have a special focus on gender diversity in corporate Britain. We look at not only at some of the things that came out in various reports, we also look at what the UK could do. Yesterday, we had an interesting subsidy from the UK to actually entice Jaguar to build a factory in Somerset that's worth £500 million. We'll have a look at that. The project, of course, will come as a cost. Neither the UK government nor Tata Group, the parent company of Jaguar, said how much public money was being put into the battery plant. So we'll talk a lot more about that shortly. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London, and today, gender diversity in corporate Britain. The finance sector and the City of London in particular face growing scrutiny in the aftermath of high-profile sexual harassment scandals this year. UK lawmakers are also now investigating whether firms are doing enough to tackle pervasive sexist attitudes. Now, the inquiry will look at whether misogyny, sexual harassment, and stubborn pay inequality have been sufficiently addressed. Almost 20 women have recently come forward with allegations of harassment against hedge fund titan Crispin Odey, which he's denied. There were also multiple claims of sexual assault by employees of Britain's largest business lobby group, the CBI. What about the pay gap? Well, the sector is, of course, lagging when it comes to compensation and career progression. Women in financial services earn, on average, around 26% less than their male counterparts. That's double that of the wider workforce. And the share of female leaders across top financial firms increased just 2% or 2 percentage points to 35% last year compared to previous years. Now, the statistics, of course, are a stark reminder of the lack of progress in gender equality in the workplace. So let's discuss all of this, maybe find some of the solutions that some of the companies are trying to put in place with the Albright Chief Executive, Viv Paxinos, Childs Farm founder, Joanna Jensen, and we're also joined by our very own London Bureau Chief, Ruth David. So thank you all for joining us. Ruth, you're the mastermind of a lot of the stories, investigation that really Bloomberg puts forward on these very important topics. We need to break it down. So, of course, sexual harassment is not the same as gender pay. But if you look at some of the metrics that we cover, certainly on a weekly basis, is there anywhere where women have been leading, where they've been doing better because of society understands the need for diversity in businesses?
I wish that were the case. You brought up Crispin Odey. The thing to remember is Bloomberg and a few other outlets have been writing about his alleged misconduct for years, and nothing has come of it. There's a question about whether the regulators are doing enough to change behavior and whether there are enough institutional barriers in place to ensure that men at the top that have so much power when they're controlling entire organizations, there are checks and balances around them. And to bring us back to the point around pay disparity, and maybe, Vivian, I would love to hear your views on this, because some top male executives in the finance industry say that it's actually not a question of discriminatory pay, it's a question of there being far fewer women in the industry. And is that true? But is it also true that women are being discriminated against?
Yeah, and one of the questions, of course, that we've been trying to work on is if you're, a female and you're rare and far between, maybe you should get paid more if there's a competition to attract you in some of the top banks. So, Viv, when you look at Albright, you do some amazing work trying to bring women together, and it really starts from a very simple philosophy that men have had networking for a long time, so you get to know each other, you help each other out, and you're trying to recreate this for women. When you have your membership, Albright, what do they come to you with? What do they need, actually, in terms of support?
Absolutely. So Albright is about supporting women across all stages of their career, and I think that's key to what we do, because when you look at senior women and the attrition we have at that high level is quite high. So I feel that in order to drive that systemic change, we need to be thinking of the future pipeline of leadership. So I think organizations are not doing enough to support those middle managers to go to the next level. From an Albright point of view, what we do is 3 things. We support women from a networking point of view. We create safe spaces for them to cross industry network, and we know that women who have networks are more likely to stay in their roles. One of our latest piece of research called The Future of Work, and it surveyed over 2,000 women, found that 38% of women are actively looking for new roles. If you think about that in the context of Bloomberg, for example, you've got 20,000 employees, 33% women. That is 2,500 women actively looking.
But is that good or bad? Does that mean that they want career progression, or is it because they're unhappy with
But they're not staying long enough. So only 10% are staying for longer than 5 years. So they're not progressing in the organizations, which is going to create a huge issue for a lot of the large corporates. So what we do is create a space where they can network, where they can find mentors and have the upskilling they need in order to achieve their goals. So our mission is about removing all those barriers in the workplace.
Joanna, you really deeply believe about this. You basically founded Childs Farm, and you basically had to go through the difficult things of finding funding, of getting support. What did you find as you grew Childs Farm into something quite big and very recognizable? What was the hardest stage as a female entrepreneur?
Well, I have to say, look, I worked in the city. I left nearly 20 years ago now, and it really disturbs me that we're still having the same conversations that we had nearly 20 years ago right now. But for me, I'm quite a punchy individual, but even so, I had to jump through, I would say, extraordinary hoops to get the attention of men. I mean, not forgetting as well, I did a baby and child product, so that's not a serious product, is it? You know, regardless of what it was, I was running a business, and I was running a business that was really hugely successful and grew incredibly quickly. But I can say, you know, now that, you know, of my 26 shareholders, many of them never actually asked me a question. They would ask my business partner a question, and I might call him my business partner because he was the second largest shareholder and he did a huge amount to help me with the business. But whenever there was a question when it came to the Articles of Association or growth or a relationship with a retailer, it never came to me, it always came to Andrew. And we used to laugh about it. But, you know, and we would talk about behind the scenes and sort of say, he'd say, listen, can you deal with this? Or he would say to their faces, you know, that's a question you need to be asking Joanna. But, you know, I've been described as being emotional, you know, in a man, it would be passionate. You know, you have to be pretty punchy to cut through the noise when it comes to starting up a new business. But let's not forget, as a woman, even now, this has grown. According to the Rose Review, we are getting less than 2% of investment capital that's available in the UK, which is miles behind our European counterparts and those in the US, because we are still not taken seriously as businesswomen.
But Joanna, what I don't understand is that, you know, some of the rooms that certainly, you know, we walk in with have changed over the last 5-10 years, right? It used to be male only. Now there are many more females. When you speak to bank chief executives, they say, look, we want to support more women. So is it the greenwashing of female inequality, or is it just that we're progressing but at a glacial pace?
I think it's a bit of both, actually, and I think that's a really good summary, Francine, because what I'm seeing is we're still overwhelmed by, what's that wonderful expression, male, pale and stale. You know, these are people, you know, let's just go back a second. 65% of all shopping money, if you like, for want of a better word, is actually in the hands of women, and yet we are running businesses largely run by men. And until we can have boards or senior leadership teams which are representative of their consumer, you can be as empathetic as you like, but until you are representative of your consumer, I'm not sure how you're going to deliver to them. And because we base everything, economics is based on GDP, we're expecting growth at every single avenue. So we're putting so much pressure on people to deliver where they don't have the skill. Bring a woman into the mix and you're getting a much more diverse opinion. Likewise, you know, it could be somebody who is transgender or gay, or it could be someone young, or it could be someone old. But if you know what your market looks like, you should have representation that reflects who you're selling to and what your market is, if you want to win, surely. But we seem to be still stuck in this arena. It's kind of like you know, someone waves a flag when they've got a woman on the board. I'm a great believer it has to be the best person for the job, regardless of what gender they are. But you also have to embrace diversity of your consumer, diversity of your customer. And if you don't, I'm not sure how you're going to get this growth.
And that flag waving, and I would like to bring you in, Viv, on that. Because, no, you know, you just mentioned this idea of companies saying we have a woman on our board. There was a lot of that going on when the markets were doing well. So when IPOs were happening, when the tech sector was doing well. But there's this very interesting research from you saying that women were 65% more likely to be impacted by tech layoffs.
Yes.
Which is crazy given that tech companies are majority run and populated by men.
And when you think about AI, 70% of the jobs that are going to go from because of AI come from, will be jobs that women hold. I mean, just to go back on a question you asked, I think there's a big gap between what leaders say and what leaders do. And I think there's often a diversity tick box that we need to get away from. You know, investing in women, investing in diversity is not a nice to have. I mean, it's very simple. If you want to, every business wants to drive growth. That growth comes from innovation. Innovation comes from diversity of gender, generations, diversity of thought. There is still 80% of employers that pay men more than women. And that has to change. So we need to see more action and less talk. And that's what we're trying to do at Albright with the Albright Alliance.
Okay, so we'll talk a little bit about the Albright Alliance, the Albright Chief Executive of Paxinos. There, the Child Farm founder, Joanna Jensen, and our very own London Bureau Chief, Ruth David, all stay with us. Coming up, why work still is not working for many women. The discussion on gender equality and diversity continues when we return. This is Bloomberg.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now let's continue our discussion on gender diversity. In corporate Britain, Albright has published a report about how its members feel about the future of work for women in 2023. Now it reveals that almost 3/4 of women surveyed are unhappy with the rate of career progression. 83% of women take an additional unpaid or unrecognized responsibility at work, while only 1/4 of women surveyed plan to stay in their current roles for the next 2 years and beyond. So still with us, the Albright Chief Executive of Paxinos Charles Farm founder Joanna Jensen and Bloomberg's London Bureau Chief Ruth David. So thank you all for joining us. We're just getting started with a pretty heated debate on actually what needs to change, what hasn't changed, what we could do better, and everything in between. And you were talking about, so you do some great surveys, but there's also an alliance that you've put in place, which what basically pledges companies to just invest more in women?
Correct. So the alliance is really to bring together a collective of companies who are committed to making change in the workplace and to make work for all women. We already, through all our alliance members, we represent 280,000 employees, 133,000 women. So there's some really innovative titans in business that have joined our mission. And what we do, we start with a a data diagnostic to understand what's happening in the workplace. We take that data from the X-ray that we do, and then we create a framework in the blueprint to drive success with different data checkpoints throughout the year, and then they pledge across 5 pillars. And at the end of the year, have they achieved the criteria that we've set, then they get certified as an Albright Alliance member.
And the Parker Review, of course, is now changing what its targets look like, right? So first it was all about women on boards, but now they're saying we want people from ethnic backgrounds, minority people on boards to show diversity. The billion dollar question is, how much is having these women on boards actually making a difference to gender diversity across the organization? And while companies in the UK have voluntarily met a lot of these targets, the progress that we are seeing in terms of when you go across the management level, so even if you have a female CEO, the next level down, how many women do you have in leadership roles? And I think that is a question that we're all struggling with, and it's not just a UK issue, and we haven't even got to the very thorny topic of maternity leave yet, which the UK arguably does better than some other countries. But then do you get the same job when you go back? Is your promotion guaranteed after a year? Do you get your bonuses? And in finance, those are the burning questions.
Yeah, and this is a difficult question to answer, right? I don't know whether you have, survey or research on this, is that if you have a female CEO, it doesn't necessarily translate if she doesn't have the power to change the organization into, female talent retention or hiring.
And that's where there are different checkpoints throughout the year. When you're doing your annual reviews, when you're recruiting, removing the bias from recruitment. So it's not just about female, but it's that intersectionality of different ethnic minorities as well. So it's removing those biases throughout your recruitment process. And it's also making sure that you use the opportunity during annual reviews to get to gender pay parity. If we close the gender pay gap in the UK, we'll be adding 150 billion pounds into the economy. Right? It's a simple math equation.
Joanna, you're also an amazing entrepreneur because you successfully built a company, and then now you're trying to mentor younger female entrepreneurs to basically have the success story that you've had. Have the questions they ask you changed over the years? And again, if you're in a managerial position in a large company, if you don't have enough power to change into more diversity, like what's the right way of dealing with that?
I think what I'm seeing is definitely women that need some support. I was talking to one woman the other day who had an investor come on board. They insisted on a board position, and she was being bullied by this man in the board position. And I coached her through how to address that. And this was, a position of 13% of her business, and somebody, telling her how to run her business, how she was getting everything wrong. And I think part of the fundamental problem is that, men are very good at networking. And this is why organizations like Albright, like By Women Built, set up by Sahar Hashimi, are so brilliant about bringing women together so they can network and learn from each other, and also build that confidence when they're going into a situation to really help grow. And typically, I think what I see is female-founded businesses tend to be a lot more female-heavy when it comes to their employees. But again, it depends on the product that they're doing. I think naturally what I'm seeing through SMEs is there is this natural diverse workforce, and that's brilliant. What that needs to do is permeate through to bigger PLCs, corporates, who actually realize the skill set of their diverse workforce and how it can, I'll go back to what I said before, grow their business.
Yeah, I think that's a great point. I'm sorry, can I go? Yeah, it's all about driving that growth, and leaders need to, again, move away from it being a tick box exercise to being a must-have. In order to drive growth, they need to have the diversity in the workplace. And I hear a little bit of apathy when I speak to leaders about it. Oh, you know, we're just not investing in women. We don't want to be seen to just be doing something for women. But women and men face different challenges. It's not about excluding men, but it's just recognizing that women go through different challenges, and you need to have that gender-inclusive strategy, because if without that, then you don't have a growth strategy in place.
One of my favorite things in the world is actually when viewers write in, and we have a male chief executive saying, look, I'm watching you at the moment on screen, and my first observation is that he's trying to recruit females, and it's actually quite difficult to find skilled females, possibly also because of COVID. So we'll get onto that in just a second. Albright Chief Executive Viv Paxinos, Child Farm founder Joanna Jensen, and Bloomberg's London Bureau Chief Ruth David all stay with us. Coming up, we discuss the way forward for women in the workplace. In corporate Britain, we try and talk about solutions. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back as we continue our discussion on gender diversity in corporate Britain, still with Albright Chief Executive Viv Paxinos, Child Farm founder Joanna Jensen, and Bloomberg's London Bureau Chief Ruth David. Joanna, you've lived through this. You've had to do it. What would have made your life easier? Is it childcare? Is it actually, being recruited differently? Like, what would make a difference?
I think for me, look, I was a single mum when I was running my business, and childcare to me was an enormous cost. I mean, I would say sort of 75% of my income went on childcare. And let's think about these trips that we have to do, international trips. When did we ever get paid for that additional childcare we needed when we were on a trip? And that happens across the board now as well. But this whole part of the role of women within the family, and this is not stigmatizing women, it is just naturally we're extremely good at caring not only for our children but also for elderly parents. And I'm in that position right now where I have a mother with dementia, I have 2 teenage children going through all their exams, everyone needs me, and I still have to do a job. And I'm a founder. I made a different staff. But if we really want to attract women into the workplace, we want to give them progression up the career ladder, and we want to reward them, we need to understand these unique circumstances that women have beyond just working in an office.
And I would say two other things to that. Work from home. When we are recruiting, one of the top questions we get from working parents, majority of whom are women, is what are your work from home policies? Finance companies are going back on all of that right now. How do you get women in the senior level to be there with you?
Yeah, and Viv, there was a pretty explosive article that came also from your survey saying a lot of women don't progress even if they do a lot of the feel-good mentoring, important stuff in workplaces.
Yes, and that's about shifting the mind from it being a cost, but to a value creation. So women disproportionately do a lot of that unpaid work in the workplace as well. And that adds to their burden. And what we've seen from our survey is that women are stepping down because of those unrealistic expectations. Not only do they have caring responsibilities at home, they do more in the workplace. But as a solution, as you just said, Ruth, it is around companies making sure they adopt a flexible work policy and understand what women need. And that needs to be ingrained across every organization. I was really pleased to read that Amazon is offering sabbatical to mums who need to take the summer off to look after their children. I mean, that works, right?
Yeah, and if mentoring is actually seen as a hard, P&L measurable thing, then it means that females that do that can also progress further quicker.
Yes. And same for diversity, right? Because you want more people that, even if they look and sound different, can tell your story and can relate to you.
Yeah, controversially, I mean, I'm seeing a lot of people saying, look, a CEO's compensation should also be tied to how much diversity there is in the workforce.
I 100% agree. And it's that point you said about the P&L. We need to look at measurement in a different way and success in a different way, because we're still using traditional measurement, traditional P&L, which doesn't reflect the workplace of today.
All right, thank you all for joining us. The Albright Chief Executive of Paxinos, Child Farms founder Joanna Jensen, and Bloomberg's London Bureau Chief Ruth David. Now, we also have great verticals, of course, looking at this very story. We have a full team looking at equality and inequality in the UK. Bloomberg Surveillance Early Edition is up next to Kriti Gupta in New York, Danny Berger here in London, and this is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Tesla sinks as Elon Musk warns of more blows to profitability, while Netflix also slumps on a disappointing revenue forecast. The yuan rallies. The PBOC ramps up support with a stronger fix, with officials considering mortgage easing in China's biggest cities. And wheat prices rise further after their biggest surge in a decade. Russia makes threats against ships sailing to Ukrainian ports. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London. Sonali Basak is in for Kriti Gupta in New York. Sonali, so great to have you on the program. You can relax. The bank earnings are done, but we have a lot of other earnings to sort through this morning.
Absolutely, and I have the rest of the week to do that just with you. Let's take a look here, though, at the U.S. markets first, Danny, before we get into a big show. Looking into some of the negative data we're seeing here, we have S&P futures down so far on the day, as well as NASDAQ 100 futures. We're going to dip into earnings we're seeing from semiconductor makers, as well as Tesla and Netflix, dragging those futures down just a little bit here. We also have, I want to pay attention to the U.S. yen cross, the dollar-yen cross here, failing to break the 140 level. And it's an interesting moment here after a bit of strength here. We are seeing some weakness in the cross. I want to point to wheat prices as you're talking about as well, because we're seeing even more strength in wheat. There are a lot of inflationary concerns here. This is as Russia had shot a warning sign over ships in the Black Sea related to the grain prices. As you said, it was the biggest surge in a decade, and we're seeing that extension here today, Danny.
Yeah, and to be clear, it's not just wheat. We are looking at commodities rebounding today in general, not just on that Russia story, but on China's support. Sonali, you put it perfectly. It's the inflation fear that this brings. So a couple things happening in the Asia session. The strongest fix for the yuan of this year. We had some capital fund changes in terms of cross-border flow to promote that. We also had officials considering making things more easy to obtain a mortgage if you're in a big city. And then yesterday, there was also a report about them supporting private businesses. You put that all together, it adds to a commodity rally. Iron ore is what I have on my board, up 2.5%. It also meant some pretty solid strengthening in the yuan. Offshore stronger by about 0.6%. It also supported commodity currencies. I got Aussie on my board. That's stronger by 0.8%. But here's the rub. Stocks in China did not rally off of the back of this. The CSI ended the session lower. Perhaps there's some skepticism as to whether this is just a Band-Aid or something that fundamentally drives the picture. The other bad thing for stocks in the Asia trade was TSMC earnings. We're going to get into that with our reporter in just a bit, but that also translated into issues for the Europe session. Let me show you what's happening here in Europe, because technology stocks are dragging down the overall index, down nearly 2%, the worst performing sector. It's all the chip stocks. It's everything that might move on the fear that TSMC is warning their cut is going to mean bad news for Europe's chip sector too. Meanwhile, another day of weakness for sterling after that blowout lower than expected number, CPI number yesterday. But two-year yields, those do creep ever so higher, but I mean barely, Sonali. They're really holding on to that rally that we saw yesterday. But But again, as we say, a lot can change today considering all of the earnings news.
Absolutely, some rallies hitting some hiccups. We're going to talk about one of those rallies, that is Tesla, now lower in pre-market trading as the car maker warns of more hits to come to already shrinking profit margins. CEO Elon Musk saying sacrifices will help future valuations.
I think it does make sense to sacrifice margins in favor of making more vehicles, because we think in the not too distant future they will have a dramatic valuation increase. I think the Tesla fleet value increase at the point at which we can upload full self-driving and it's approved by regulators will be the single biggest step change in asset value maybe in history.
Now for more on Tesla, Bloomberg's Oliver Crook joins us now. Oliver, what do we care about when we look at the Tesla earnings today?
Hey, Sonali, this is really coming down to two things. That is market share and margin and the war between the two. That war is being waged in price cuts for Tesla, down some 30% on some of their models from the end of last year. And, we looked at, that's the only thing people really cared about looking at these numbers, the profit margin. Gross profit margin came in at 18.2%. That was a miss despite beats across the other metrics. And really, if you look back 4 or 5 quarters, that is down from something close to 30%. And Elon Musk last night said, you know what, he's willing to burn that even further. So his attitude towards the margin is, if you've got them, smoke them. The question is it working? They delivered 466,000 cars in the second quarter. That was a record. In Europe, for example, the Model Y was the single best-selling model in all of Europe. Yesterday, we got June data out. Tesla outsold Nissan, it outsold Volvo, it outsold Citroën and Fiat. These are all local players that it's beating in its own market. There are some clouds on the outlook, however, though they do have kind of demand that's there, but it's not where it used to be, and they're managing to work through it. And so you're seeing some of their inventories come up. That's 5 consecutive quarters, so that's sort of an issue for them going forward.
I mean, look, it might have been an ugly post-market session for them, Oliver, but I just pulled up the one-year chart of Tesla. Am I looking at this right, that they've rallied 130% so far this year?
Yeah, so listen, we lost what, at 1.4%, now 2.5%. That could be a big deal for some people, but who cares? If you owned Tesla at the beginning of this year, you made 130%. So yeah, there's a degree to which it doesn't matter that much. And there are a couple other milestones this quarter which we watch with interest. For example, Ford and GM adopting the Tesla sort of standard plug, which again, maybe not huge for sort of earnings for Tesla, but it shows how far ahead Tesla is in the e-mobility ecosystem. And Danny, the final point, the Cybertruck. There are a lot of memorable moments in Tesla history. However, the one 4 years ago where they demonstrate the shatterproof glass that shatters on impact twice will be hard to forget. And that truck was supposed to be delivered some 2 years ago. Now we got the first one rolling off the assembly line in Texas. We haven't seen him on the streets yet. But again, this is kind of Elon Musk at his best, bringing something new hardware to market that, it'll be very strange to see these on the roads, probably not till the end of this year, realistically at the end of next year, but still exciting.
Also doing what he does best in creating memes. That image of the thing shattering will live on throughout internet history. Oliver, thank you so much. That's Bloomberg's Oliver Crook. And we're going to get you more analysis on Tesla's results. We'll be speaking with RBC analyst Tom Narayan later this hour. The other big earnings to sort through is Netflix. Those shares slumped in the pre-market after the streaming giant gave a disappointing revenue forecast. Despite beating expectations on subscribers, the crackdown on password sharing and a new advertising tier just aren't delivering growth the analysts expected quite yet. The Netflix CFO, Spencer Newman, tried to reassure analysts on the earnings call.
Only a small percentage of our members are on the ads tier, even with the moves we just mentioned. Nice growth in the ads tier, but still off a small base. And we're really early in terms of paid sharing impacts, including extra member, for the reasons that Greg mentioned. That's going to build up over multiple quarters.
Bloomberg's Olivia Solin joins us now for more on this. Olivia, what do you make of the price action this morning? Because, they did add a significantly higher amount of subscribers than was expected.
Absolutely, yeah. They had this huge subscriber increase, 6 million, compared to what analysts expected to be about 2 million in the last quarter. But, as you say, they've had this slower than expected ability to generate more revenue from this strategy, which has involved cracking down on password sharing and also introducing this ad-funded tier.
Olivia, how do we expect the Hollywood strikes to affect the business?
Right. Well, the Hollywood strikes, it's a bit of a mixed bag for Netflix. On one hand, it's affecting some of the production of some of their hit shows, like Stranger Things. It's completely shut down. But on the other hand, it's cut production costs for the company. So they're projecting, much reduced costs this year. Netflix will obviously say that they have this very deep back catalogue of movies and shows, and they also produce quite a lot of content internationally. So they think that's going to mitigate the impact of the strikes.
All right, Olivia, thank you very much for that update. That is Olivia Solon from our Bloomberg Tech team. Elsewhere in tech news, chipmaker TSMC posted a smaller than expected profit decline after the global AI development boom outweighs a persistent slump in smartphone demand. But Asia's most valuable company says the full year sales will fall by 10% in dollar terms. For more on this, let's bring in Tim Kolpan from our Bloomberg Opinion team. Tim, what is this? I thought AI was supposed to save all the chip companies. I mean, this doesn't look great for TSMC.
No, it was a real bombshell they gave us a few hours ago when they said, oh, actually, yeah, sales will drop 10% this year. Previously, they'd said low single digits, so 3 to 5%. AI is definitely giving them a boost, but even the category of AI, which is high-performance computing, is kind of soft right now. So for the whole year, smartphones are the big problem, but AI is just not enough to fill that gap. The other thing is that if we look at the numbers, TSMC's inventory has risen. The company is now sitting on $7.6 billion of inventory. Now that's chips. Chips kind of go bad, so to speak, very, very quickly because it's a very time-sensitive sector. You don't want old chips sitting on the shelves because no one will want to buy them in 6 months. That's a big problem, not just for TSMC. It's a big problem for the whole global economy because everybody uses products that they make. And if people are not buying chips, then it means that the whole economy is kind of slowing down and looking weak. Apple, for example, doesn't want to buy last year's chips. Qualcomm doesn't want to use chips from a year ago. They want the latest chips that they're designed and getting TSMC to make. So the high inventories and the worse than expected outlook for this year is weighing not just on TSMC, but on really a broader sector of the economy, of course, in Europe and in the United States.
Speaking of the United States, Tim, put into context for us what it means for TSMC to delay the output from the plant in Arizona.
Yeah, that's the other big bombshell that came today. Chairman Mark Liu told investors today that they're really facing problems getting skilled labor at that Arizona site just outside Phoenix. You need a special type of worker, someone who's got experience in handling and installing the very sensitive chip-making equipment that's going into that site. And they've been trying to get the right kind of people in the US to do it. In the end, they basically said, well, heck, we'll just have to bring our own people in from Taiwan. So they've been flying in plane loads of people from Taiwan to Arizona to live there for a temporary period of a few months to basically get that job done. But because of that, they've now pushed back by as much as a year, so back to 2025, the opening of that factory. Now, that factory was supposed to get going next year, but a delay of up to a year says a lot for the US about the skill shortage that they have there, and the fact that the US really doesn't have the skill set that they used to have in installing high detailed or sensitive semiconductor manufacturing equipment. So that's a real problem for the US. It really does reflect badly on the United States economy.
I'll tell you what, Tim, for all of the concern about PCs and mobile phone demands, it is remarkable to look at Apple hit record high after record high, this time on their development of an AI ChatGPT-like rival. How far along does it seem like they are here? Is that rally off the back of it justified, do you think?
Well, I mean, I don't call stocks, but I'd say this. Basically, Apple has been out of the game when it comes to generative AI. They've been using AI for a while. Siri, for example, has AI. And they're actually quite good at AI that is used to look at photos and edit photos and search for photos on your phone. But they've stayed away from generative AI for a few reasons, one of which is privacy concerns. As we know, programs like ChatGPT, they hoover up really a lot of data. And in fact, we don't even know where that data comes from. That's part of the problem. Apple is, really big on privacy. And so what they've done according to our exclusive reporting from Mark Gurman, is they've developed something internally, which is somewhat of an internal replication by Apple of things like Bard and ChatGPT. It's not designed at this stage to be used for consumer applications or released to the public, but it does show that they are trying to make use of these kinds of technologies, even if internally, and they're treading very, very carefully and cautiously into that realm. So the fact that investors are seeing that they are not asleep at the wheel, perhaps they are interested and they are involved, is certainly upside for the company and for the stock.
Tim, thank you very much. That's Bloomberg Opinions' Tim Kolpan in Taipei. Now, coming up on the program, the price of wheat keeps on rising after posting its biggest daily surge in a decade. We'll get more on that next. And coming up, some breaking lines over the euro area economy. Eurostat has revised their first quarter euro area GDP statistic to zero. It was at a negative 0.1%. So Europe dodges a recession in the winter. We're going to catch up with Gordon Shannon of 24 Asset Management on his take on Europe, European bonds, and the Fed. Also, coming up later in the show, we're going to talk about the next big risk. It premieres tonight. It features Boaz Weinstein and David Rubenstein. We've got a sneak peek of Sonali's conversations there.
The next time there's a serious sell-off, which is not just a 3-week affair, there are a number of aspects from the behavioral to also that the Fed is not your friend and in fact will not be able to come to the rescue of the market in the same way because of what's going on now.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Surveillance Early Edition. I'm Sonali Basak in New York with Danny Berger in London. Wheat prices are extending gains onto day 3 after posting its biggest daily surge since 2012 amid escalating conflict over grain exports from the Black Sea region. For more on this, we're going to bring in Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Will, when you take a look at the issue here, clearly a second day of gains here, drastic moves in wheat prices alone. How much upward pressure is there on wheat and other related commodities? Where are you looking?
People in the agriculture markets have clearly decided that this is a pretty important event. The fortunes of the grain corridor, this idea that grain could continue to flow from Ukrainian ports despite the war, that there was a UN agreement that Russia would allow that to happen. I think what we can say is that is now over, at least for the time being, and that the market realizes that Russian threats mean that it's very unlikely that any grain will be coming out of that corridor. And although its exports remain constrained, Ukraine still remains an important supplier to the global wheat market. And as the latest harvest comes in this summer, people are concerned that much less of that grain will get to market than previously thought.
Then, okay, so if prices are around $7.40 at the moment, they were something closer to $9.40 at the peak of the height when Russia first invaded Ukraine. So is it reasonable to assume we go back there? Should things be completely blocked?
Not necessarily. As I said, people are living without much less Ukrainian grain than the world was before the war, and we have strong harvests elsewhere, notably in Russia, and Russian exports continue. And of course, one of the attractions of this policy for Russia perhaps is that it boosts the price of wheat and therefore boosts the price of its own wheat, and it's good for the Russian economy. I don't think people think that we're going to retake those limits at the moment, because Ukraine right now is a relatively small slice of the global wheat market.
Okay, so does that mean then that for this to turn into a story like it did last year, where we get concerned about food inflation in general, that ability is then lessened?
Yeah, I mean, it's not comfortable. I mean, a 10% jump in the wheat price over just a few days is obviously a matter of concern, and and some of that pressure had come out of global food prices in recent months, and this won't help and may slow down that process. But ultimately, the wheat market is determined not just by this, but by the level of harvests around the world and the amount of supply around the world. And right now, that looks pretty healthy.
Okay, Will, thank you very much. That is Bloomberg's Will Kennedy with the latest on wheat prices and Russia. Grain coming out of the Black Sea. All right, coming up, big bank earnings wraps up. Sonali finishes what's probably her most busy 3 days ever. But she's not done. PE's up next. Blackstone's going to report before the bell. We'll have more on that next. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
From New York City, from London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
So with Goldman Sachs reporting yesterday, we have all of the big bulge bracket banks in the books for the earnings. Chanel, I got a question for you. How much sleep do you think you got cumulatively so far this week?
Actually, I have been clocking 8 hours a night, if you could believe it, to the extent that I was able to get to bed before 9 p.m. That is
extremely impressive, considering, I mean, like, the thing with the banking season to me, Chanel, seemed that there was just a lot underneath the surface, a lot of divergences, which I think you would have needed 8 hours for. I was listening to the Mike Mayo interview the team did yesterday. Basically, optimism that the woes are over, the liquidity, the capital, the solvency woes, that banks have turned a page. Was that your impression sorting through all these earnings?
Yeah, what's pretty incredible is that you've had Bank of America trading under book value. For what? They're increasing their net interest income. They're making money. You have a couple days in a row here that you saw such exuberance in the KBW Bank Index. Mike Mayo is telling us that he has seen the worst valuations for banks in his career, in decades. And so there's a lot of question about the place of the banks, how much pain is left. We're not done yet. There's a host of regionals, there are credit card companies, Capital One today, a lot of questions about credit quality. Never ends.
Yeah, that is a really good point on regionals, seeing them really adjust their balance sheets. I mean, they have more capital requirements to deal to. We're looking for any signs of continued credit crunch. What are you expecting out of it?
Yeah, you know, it's incredible because if you think about that credit crunch in particular, there's two things going on. You have the regional banks reporting earnings, and you are seeing some pressure on net interest income. At the very, very same time, today, we have Blackstone also kicking off private asset firm earnings. We know they're making a huge push into private credit. So how much competition are these guys going to be giving not only the regional banking system, but even those big banks that are seeing underwriting come back?
I gotta say, everyone seemed just so hype, Shanali, about this idea that capital markets are coming back. Goldman was able to rally because its CFO said that it was coming back. Morgan Stanley, their big leg up was when Gorman told you that capital markets, that deal flow was coming back, that it had bottomed. I'm interested to see whether Blackstone backs up that view.
Yeah, same. And the interesting thing is, even without a flurry of deals, you've seen Blackstone just take a surge in markets this year. They're trading at a valuation right now, a market cap that is more than $10 billion more than Goldman Sachs. So that shows you what the market wants to see.
Yeah, these things are massive. I mean, Shanali, not to be controversial, if you're bigger than Goldman, do we need to have a regulatory conversation here? Do we need to have a too big to fail conversation?
Not controversial at all. I think the private equity guys will say, look at BlackRock first. They're so much bigger. Why target us? But, you know, as Don Lim at Bloomberg has reported, this could be a landmark moment for private equity with Blackstone potentially passing $1 trillion in assets.
Well, Shanali, I'm really looking forward to your interview with the Blackstone CEO. We're going to be rolling that out later. That's, of course, Jonathan Gray, after the company reports its quarterly results. Up next, we turn back to the bond market with Gordon Shannon of 24 Asset Management. This is Bloomberg.
been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance Early Edition, and here's what you need to know for today. Tesla is sinking as Elon Musk warns of more blows to profitability, while Netflix also slumps on disappointing revenue forecasts. Then the yuan rallies, the PBOC is ramping up support with a stronger fix as officials consider mortgage easing in China's biggest cities. And there's wheat prices rising further after their biggest surge in a decade as Russia makes threats against ships sailing to Ukrainian ports. I'm Shonali Basak, stepping in for Kriti Gupta in New York with Danny Berger in London. Danny, give me a look at what the European markets are doing today.
Well, it could have been a good day if it wasn't for tech, if it wasn't for TSMC, Shonali. Overall, the Europe Stock 600 is able to notch higher, but you look at the big caps, the Stock's 50, that's not higher. They're all moving lower, and it's because of this drag of technology stocks down nearly 2% after TSMC cut its forecast going forward. It's bad news if you're ASML or kind of literally any other chip company in Europe. So that's dragging us lower. Meanwhile, the theme of weaker sterling, that continues. We're down for the 5th day in a row. Again, it has been a big move off the back of that UK CPI, but we have just rallied. We have strengthened so much this year for sterling, so we haven't yet undone that. And the 2-year yield, that's able to hold on to gains that we've seen in the gilt market. Looking at Asia, the big story was more China support. Is it incremental or is it game-changing? That is the question we have to grapple with. After a stronger than expected fix, after some adjustments to cross-border flow to increase investments, after some news around private companies and mortgages making that easier. So what did you see? You saw a strengthening in the offshore. That is gaining about 0.7% versus the dollar. Metals doing very well too. Iron ore up 2%. Again, optimism, maybe more home buying in cities. Aussie dollar, some jobs data in Australia that impacted that, but nonetheless, commodity currency is rallying. But again, stocks not performing, partially on TSMC, partially on some pessimism. Shonali, so is that any of that carrying over to the U.S. session if you're looking at Asia stocks falling?
Yeah, absolutely. I was going to say same here, Danny. If you take a look at S&P 100 futures, they are slightly down on the day so far. Same with NASDAQ 100. This is a little bit of TSMC here. It's also a little bit of Tesla. It's a little bit of Netflix. We'll see how the continuation of earnings season plays out, of course. These are stocks that have massive rallies. We also have the dollar Japanese yen cross. I wanted to take a look at it, Danny, because we are seeing some easing of the pressure on the cross here. We have it trading at less than 140. People are watching that marker to see if it breaks through. We are also watching wheat because it's up for a second day, more than 2%. This is after a major rally on Wednesday as well. And this all has to do with the Russian look at the Black Sea here and the restrictions being placed on wheat exports. Danny, back to you.
Yeah, Shonali, I realize this is about to be kind of an awkward pivot because you were just showing us futures that were moving on earnings, but for the most part, American equity, American risk in general has held up very well this year. Take a look at high yield spreads. I have both the high yield spreads and the global ag on here. So IG spreads, they've all been contracting. In fact, high yield spreads are the tightest since April 2022. Nothing seems able to dent that risk appetite. Does that crack at some point? Does it go further? Let's bring that question to Gordon Shannon, portfolio manager at 24 Asset Management. Gordon, what does the high yield rally do from here?
So currently the market's digesting this reevaluation that we're going to have a soft landing, and that's all based on these inflation prints. We've had the US, Europe, and even the UK give us falling inflation, which massively increases the chances that the central banks can pull off a soft landing, get inflation down without pushing us into recession. So it does open the way for a further squeezing tighter in credit spreads. What I'd seen so far this year is large inflows into investment grade, because when you've got an uncertain macroeconomic backdrop, you want quality. Now I'm starting to see clients want more duration, ultimately more gilt exposure, but I think that there's plenty of room here for people to push further into high yield because they've just got that bit more certainty.
I know this is difficult to answer since we're only just at the beginning of earnings season, but do the fundamentals back it up versus just interest rate risk?
Yeah, no, not necessarily. We've seen most of the Q3 earnings be down, but yet the equity market has held up very well, leaving today aside. So valuations are becoming more stretched, but I just don't see any appetite right now for people to properly assess downside risks.
Speaking of downside risk, Gordon, I mean, how much exactly is there in terms of your expectations for any loss of capital for all the people who have poured into high yield thinking it is sanguine enough to do so?
I think the expectation is, even if we have a softish landing, that default rates are going to stay low. So as long as you stay away from the lower quality end of high yield, the triple Cs, the scope for capital gains and to avoid defaults is high.
Well, speaking of taking on a little bit of risk here, I mean, how far down the spectrum should people really go? I mean, is there a sense here that high yield maybe gives you better protection than, say, the leveraged loan market, which is trying to make its way back?
I mean, what I think is particularly interesting here are callable bonds with extension risk if they aren't called, because as we've got more clarity that yields are going to come down, the expectation that those bonds will be called goes higher. We don't have to worry about them staying outstanding to perpetuity. So here I'm talking about bank AT1s or corporate hybrids. So those have beta just like high yield, but at this point there's potential not just for strong levels of carry, but also for capital gains as those bonds are taken out.
So the sovereign bond market, this rally has just been fueled by UK yesterday, basically all the data we're getting. What are the odds that the BOJ announces something like a tweak of YCC and completely upends this whole thing?
You have to keep open to these things. They're trying to balance a number of different features. I think what central banks everywhere are worried about is that the labour markets are still tight.
Right. But wait, just on that point of the BOJ, if they do tweak YCC, does that upend the rally? Do we need to reconsider the ability for bonds in Europe, UK, US to keep going?
I think the market will find a way to look through that.
So it doesn't care, it keeps rallying?
Yeah, I think so, yeah.
Huh.
I mean, the other thing about this, too, that I've been wondering is how much risk is there to just inflationary shocks in particular? I mean, we're talking about this cross-current in commodity prices right now with the re-escalation here on the attack on trade, on wheat. But how much could those types of ripple effects really ruin the trajectory that we're on?
I think the base effects are so high that regardless, you're going to continue to see a fall in headline inflation. But what the central banks are most interested in is core inflation, and in particular, core services. That's generally what they look at as their proxy for domestically generated inflation. So, while commodity prices going up, eventually those do become an issue, and I think they feed into a wider geopolitical problem. It's probably less of an issue for the next couple of prints, and something that the central banks won't be paying as much attention to.
If I can just jump in here, because, as you say, we're going to keep rallying. The narrative seems to be one more, we're finished. Soft landing. Even Marko Kolanovic is saying there's going to be a soft landing, which I think means something. I just can't help but wonder, Gordon, are are we reading too much into it? Are we too optimistic? I mean, we've only had a few data prints at this point.
Well, that's it. You know, one data print isn't a trend. And as we've talked about before, I'm a big believer in the yield curve, and the inversion of the yield curve tells us a recession's coming. Now, if we compare previous periods when we've had the inversion of the yield curve and then how long until the recession happens, sure, we you know, versus previous ones, we're slightly overdue. But if you compare us to, say, the February 1980, the Volcker-inspired recession there, that would put us at timing of us entering the recession round about December. So, you know, the fact that 2s, 10s are still minus 90, that's a red flag.
Right.
I'm really curious here about whether this idea that inflation easing is enough of a story. I mean, the bank, you know, companies still have to make enough money to repay the interest at a higher rate too. So, are there other risks tied to corporate profitability here when we're thinking about the riskier bond markets?
Well, I think that the conundrum for the market has been just how well consumer sentiment has held up. So everyone has worried about, and I'm still worried about, the cumulative impact of monetary policy tightening and when that cuts into consumer spending. But consumers, certainly in the US, have been willing to run down their savings. And thus, there's been money for companies that need it, the cash flows they need to keep paying their coupons. And there was a huge amount of refi done in 21 and 22 at relatively low costs of debt. So the maturity wall doesn't hit us for another couple of years. So there's, you know, certainly in short-dated debt, there's a certain level of comfort that we can be taken there.
And then again, this comes back to the idea of triple Cs. Those spreads have held up. What do you want to do to prepare yourself in case this doesn't come to fruition? Because, Gordon, it does feel like this is the overarching narrative for most people. If the crowd turns, where do you want to hide out?
Yeah, you want to make sure you're in businesses that can be resilient through a recession. You want to have a portfolio that's nimble, that you can change around, because there are a number of variables here. So keep it more resilient. To me, that means keep it higher quality.
All right, Gordon, thank you so much for joining. That's Gordon Shannon, 24 Asset Management Portfolio Manager. Now, coming up, Tesla extends declines with Elon Musk warning of more blows to margins. We're going to have more on that with Tom Narayan, lead equity analyst for Global Autos at RBC next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Sonali Basak is in New York. Let's turn to Tesla. The electric car maker is trading lower in the pre-market session. The company warned of more profit hits to come, more spending. Joining us now is Tom Narayan, Global Auto's lead equity analyst at RBC Capital Markets. Tom, what do you make of the price action? Was what you heard yesterday, does that sound like something that should send the shares lower?
Yeah, I mean, it's down about 2% now after hours. I think it was down more before that. I get it. I mean, the actual earnings itself was pretty good. It was a beat on gross margins. Came in at 18.2%, above consensus. But then on the earnings call, I think there were some comments from the CEO, from Mr. Musk, about spending on autonomy and software, which I think may have shrugged some investors. A lot of them are retail investors who want kind of a quick payoff immediately. And also there's some other things, more R&D spending. But the reality is, as everybody knows, if you're buying Tesla stock, you're in it because of the future and on autonomy, which is FSD, which is robo-taxis. And in order for those to work, you're going to have to spend today. But I do remind folks, if you compare Tesla to any other automaker, it still posted 10% operating income margins, and it's selling 100% electric cars. There's no other automaker that's doing these types of numbers. I think people just get caught up because the stock has run a lot into the print. But really, all in all, if you look at the big picture, I actually think this is a pretty good quarter.
Okay, fine. Pretty good quarter, but to the point you're making, the run-up in the stock has been 136% this year alone. Does it just need some cooling off here, given some of the near-term pressures they see on production?
That could be what's happening, right? I don't think anybody was expecting a 3Q cut in production. Everyone thought that they would blow out the 1.8 million units this year and hit like a 2 million number. So maybe that's not happening now. So it could be some of that. But ultimately, if you're going to own a stock like this, that's $1 trillion market cap potential, you have to believe in FSD and robotaxis. The math just doesn't make sense otherwise. And they believe they need to spend to get there. And there's not that many other companies outside of Tesla that has the cash to spend on these things. So it's a little bit nebulous now. What is a supercomputer? What exactly does that mean? There are a lot of open questions to be answered. But this is a company that has a track record of proving itself out over time.
But Tom,
and ultimately, we think that's probably
even if you believe in the long term of Tesla, I think it's worth digging into here, especially because we're starting on a down day after a good day of earnings, on what the challenges are on the way there.
Yeah, sure. I mean, there's a lot of challenges, right? So FSD is it's a level 2+ system that's only maybe 5% of Tesla cars have them today. Not that many people know about its quality, but if they lower the price from $200 a month to, let's say, $50 a month, the take rate explodes and people will be better aware of it. And then robotaxi is like 10, maybe 15 years away. So it's a prove me concept. There's no doubt about it. But you remember, with this stock, it's kind of like Amazon was 15 years ago. There's enough people that believe in the future. That thesis is always there in people's eyes, that I think that does create support for the stock, especially with the AI investment craze right now. That's not really going away. So as long as that's around and that bubble, let's say, doesn't burst, if it is one, I think you're going to still see support for Tesla shares.
So if we should be patient for Tesla as it's a future story, how patient, Tom? When does the rubber hit the road? When do we finally see margins that keep up with the price action?
Oh, you're not going to see margins keep up with price action for some time, right? But the point is that, a car margin is like 10% EBIT margin. A software margin is like 80 to 90%. Now, you're not going to see that impact numbers probably for years, right? They're not going to get, the numbers of cars on the road with their software for a while. But, they did announce on the earnings call that they're in discussions with a major OEM to license their FSD software. That is very telling, because if you run the math on licensing software to other OEMs, you can come up with some big numbers. So margins probably pressured near term. They can sacrifice margins in order to get more volume on the road. But This company doesn't see themselves as a car company. They see themselves as a software company. So investors will have to probably be patient, but they could be happy with announcements like, hey, we're launching a robotaxi service in this city, and FSD take rate has expanded from 5% to 30%. And these sorts of headlines will, I think, help investors get more comfortable with the long-term investment thesis.
That's RBC's Tom Narayan. Thank you so much for your time. It's a busy day for Tesla investors for sure. Now let's get a quick check on the stocks moving in pre-market trading. We are taking a look at Tesla here. It is down more than 3% now on the day, heading into U.S. trading. We also have Netflix as well, down more than 6.6% on the day. TSMC shares down more than 2%, almost 3%. But we do have American Airlines Group. That is a sign of positivity there, up more than 2% on the day. It is part of what is leading, I believe, the Dow a little higher in futures trading relative to the S&P and the NASDAQ 100. Tough day for tech, Danny.
But you gave us one good story, Shonali, and that we will take, although I don't think American Air has even reported earnings yet, have they? So hopefully the good news can continue for them. All right, coming up, the latest episode of The Next Big Risk premieres tomorrow night, featuring Boaz Weinstein and David Rubenstein. We've got a sneak peek next. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Shonali Bassick in New York with Danny Berger over in London. Now, investing involves the business of managing risks, and the past year has served up no shortage of warning signs. I asked Boaz Weinstein, Ida Liu, and David Rubenstein what they think the next risk is for markets. Here's what Rubenstein had to say.
The biggest concern overall is a clash between the haves and the have-nots. In the Western world, the clash is going to be between the older people and the younger people. the older people are living longer and longer, but the retirement benefits are not really going to keep up with what they expect or what they need. And the younger people are going to have to say, we don't want to work that much harder just so you have a better retirement. So you're going to have Social Security in the United States, for example, not being adequately funded. You're going to have other endowment programs that aren't adequately funded. And the result is going to be more and more people are going to be fighting between a clash of age groups, you could say, the haves who are working hard and want to make more money for themselves, and the have-nots who want more money to be given to them for the retirement purposes that they need. In the emerging markets, it's going to be between the haves and the have-nots in the sense that the haves who've run the world for the last 50 to 75 years, the Western world, Western Europe, United States, and so forth, they have the wealth and they have the means to really live lives the way they largely want. The have-not nations, the emerging markets, are going to basically say, well, we want some of the wealth of the world. We want more influence in the world. We want to control some of the bodies like the UN and the bodies like the World Bank, and we haven't had that kind of influence before. So increasingly, you're going to see in the Western world, the retirees clashing with the younger people, and in the old world as a whole, you're going to see the people that have had the power for the last 50 to 70 years fighting with the people who haven't had the power who now want it. And that's how I think the biggest fights you're going to see.
The latest episode of The Next Big Risk premieres tomorrow at 8:30 p.m. New York time. Danny, you could actually find the story right now on the Bloomberg terminal as well. One of the most interesting things David had to say to me as well is this idea that inequality can only keep rising for a lot of structural reasons. One of them being that if you're here in the United States, I know we're done with the debt ceiling conversation for the summer, but one of the problems is he was saying just how much the debt load has risen, the U.S. debt load since he was in Washington himself and serving the White House. And the only idea here is you can only inflate your way out of it.
Yeah, Chanel, I've got the story up right in front of me now. As you said, it's out. I have to say, and we heard it there, one of the more depressing things he said about that topic exactly is that everyone's paying lip service to it. Everyone knows there's an issue, but what are people doing about it? Politicians recognize it, government officials around the world recognize, but I don't think they're able to do much about it. Shonali, I know the title is The Next Big Risk, so we're talking about grim things here anyway, but this is a risk that feels like no one has the appetite to solve.
Yeah, and that's why I think some of these risks are brought up in this vein. I asked 5 to 10 years, longer time horizons here, because really we talk about market, daily action trading, but the reality is if you're investing, many of these investors are trying to invest over longer term horizons, particularly at David Rubenstein, where you're thinking about private equity. But another interesting one was Boaz Weinstein, kind of really worried about even liquid market challenges with the Fed tightening, right? He's kind of really pointing out here that even market risks are not being accounted for with where we are in the cycle.
Yeah, that one I really liked, Shonali, probably just because, I think about kind of the macro all the time, but this idea that, sorry, folks, the Fed is not going to come save you this time. If we get another sell-off like we did in 2020, the Fed ain't going to step in. They're doing QE now. They're doing QT now, rather, not QE. Shonali, for me, that was pretty jarring.
And you know what? People forget about this about you and me, that you and I reported on the quants. So we pay attention to those nerdy little nuances when it comes to tail risk and the people who are watching it.
Exactly. Shonali, always remind the people of the quants. We can never forget them. Shonali, really great to have you on the show today. We'll do it again tomorrow. That's it for Early Edition. Surveillance is up ahead. Deutsche Bank chief economist will be joining the team there. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The first half of 2023 has surprised us to the upside.
Can this AI and really Uber top-led rally continue?
There's a lot of disinflation in the pipeline.
We'd all like to see better balance, certainly in the U.S. market between tech and the rest of the market.
These names that have run up so much this year, I think you do have to be a little bit cautious here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get your day started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Your equity market slightly negative on the S&P 500, much more so on the NASDAQ. Earnings after the close yesterday from Netflix, from Tesla. Let's start with Netflix right now, down by a little more than 6% in the pre-market. TK, subs not bad, pretty decent. Upside surprise there, but the outlook for revenue, not so great.
Outlook for revenue, I'm going to link it all together with Tesla, with Goldman Sachs. Yesterday, I thought that Paul Davies of Bloomberg was outstanding in a summary of the state of Goldman Sachs. They all have one thing in common: profitability, and that's going to be the earnings mantra for me going forward. You've got the revenue dynamics, Netflix ugly, you go down the income statement, some challenged, others not.
That sets up Tesla perfectly.
I do okay there.
The chase for volume over profits, TK. They're willing to take it when it comes to margins to sell more vehicles. At the same time, there was this soft spot. I think the team here at Bloomberg picked up on it pretty quickly. Yeah. Inventories, TK, just ticking up just a little bit.
Oh, no.
What does that speak to when it comes to demand?
It's more than a tick up. It's a hockey stick, and there's a great chart on Bloomberg today showing that inventory buildup at Tesla. What I noticed there, and this goes back to the distrust of Tesla, I'm going to call it constructive distrust, almost CFA distrust of what is the accounting, what are the other incomes, what are all the sub-rationalizations of profitability of Tesla. It's not like Procter & Gamble.
Well, let's be clear here. The stock is down 3% before earnings yesterday. It was up 135% year to date through Thursday.
And Netflix, same moonshot.
Clearly up 62%. Big gains as well. That's going to be the struggle for big tech over the next week, Tom. So next Tuesday, Alphabet alongside Microsoft. On Wednesday, Meta. Thursday, Amazon. And then the following Thursday, Tom, you'll hear from Apple. These are all big names who have seen some big gains year to date. How do you validate those big gains with earnings after you've seen such massive moves year to date?
Well, there it is. And Mark Gurman publishing yesterday and moving Apple with a moonshot up on how will Apple AIN. Some people push back. The stock came back down. I think it's above $3 trillion right now. You can look at that, folks, in the Bloomberg terminal. The DES screen, $3.068 trillion. But the answer is smart people like Mark Gurman are looking, and this is something absolutely new, John, for financial TV and radio. They're actually looking at their business plans. What's the business plan of Tesla? Can you see John Farrow in a Tesla? What's it called? A Cybertruck?
A Cybertruck, yeah.
You know, when will it make money?
They're going to get rolled out in a bigger way in the next 18 months, I believe.
Okay.
Huge demand for them, Tom. Massive order book.
Oh, yeah.
Massive. They look pretty cool. You don't think they look pretty cool? I remember when they were first rolled out. Do you remember that demo, that launch day, several years ago?
Yeah.
And then they threw the rock through the window, and everyone laughed about it, me included. And then you look at the order book, Tom, through the roof.
I mean, I think David Ricardo's ordered one.
David. Would you like to do the promo and get his name right?
Oh, no, you get it right, because you'll get it right.
Daniel Ricardo. Daniel Ricardo.
Excuse me.
Later this hour, 6:45 a.m. Eastern Time, so in about 42 minutes from now. He has a seat, TK. This is big. Still part of Red Bull, but he's going to AlphaTauri for the rest of the season. Very, very cool. We actually heard from Christian Horner speaking in an interview, TK.
Yeah.
And he suggested that he was doing this tyre testing with Daniel over at Silverstone in the Red Bull. And within like 10, 11 laps, they just knew he's still got it.
Yeah.
He's still got it, and they made a move really quickly to get him a seat.
Good morning to America on this. Why are we doing this? Why are John and I doing Christian Horner, Aston Martin, all the rest of them, the people we've talked to? It's a huge global audience, and the business of it is extraordinary. I mean, the money involved. There's no bounds to how GM, Cadillac, or Honda want to get into the game. There's no other sport equivalent right now.
Do you think we can get Bloomberg surveillance on the side of an AlphaTauri?
Well, you know, the Death Star's with McLaren. We're not going to McLaren right now, but, you know, I can just see. I got to talk to Mike this week and see if we can get a Bloomberg decal on one of these.
Let's see if he bites.
You know, I think
we'll see if he bites.
Stop him in the hallway. Hey, Mike, 5 million. Let's go.
Sure, let's go. Let's check out the price action. Let's get to that right now. Equity futures a bit softer on the S&P. We're negative by 0.16%. Bit of data later this morning. Jobless claims. It is Thursday, of course. That comes at 8:30 Eastern time. But we need to sit on the bond market just for a moment. We're down 4 basis points on a 10-year, 378. Yields have come lower. Let's be clear about that. We're down on 2s, we're down on 10s, we're down right the way through the curve. But, Tom, one thing hasn't changed. 2s, 10s is still deeply inverted at negative 102 basis points.
Bit chagrined at the news flow in the last 24 hours. For Global Wall Street, this is front and center. The re-inversion of the 2s, 10 spread. I'm going to let the experts tell us what it means. But to review, to go from a negative 111 up to a constructive negative 94, and we've pulled rapidly back, negative 102 now, a full percentage point difference, a 2-year higher than the 10-year yield.
We'll come back to that a little bit later. Let's just finish on foreign exchange. The euro clinging to 112, slightly stronger today against the US dollar. Euro dollar just about through 112. On my screen at the moment, we are at 112.10. Joining us now is Linda Dussel, the senior equity strategist at Federated Hermes, following earnings yesterday evening from Netflix and Tesla. Linda, as we mentioned at the top of the program, it's going to be so hard to validate such massive gains year to date. How challenged do you think this tech story is going to be over the next week?
Well, some of these names are in the Magnificent Seven, and they were easy to jump onto when the market was going up straight almost for 3 months in a row. I think it's very expected that we should have a consolidation in here, and not to talk about any company on a name-by-name basis, but the healthiest thing would be that if money started to flow into other areas of the market and broaden. And actually, we did see the equal-weighted S&P outperform the market cap-weighted S&P in the month of June. So a bit of a pullback here after almost a parabolic rise here in the last few months would not be a bad thing at all, to move away a little bit from the NASDAQ.
If we see earnings lift up, do earnings lift up because of margin surprise, or do earnings lift up because of a revenue lift?
Well, look, that's the interesting question, and we surely do hope that earnings will go up because profit margins have been declining for 15 straight months here, and from an all-time record high. But we really want those profit margins to stabilize, at least stabilize, and there's some evidence of that. In terms of the revenue piece, that would be the very good sign of a continuing strong economic situation here, because you've seen inflation start to slip a bit here, and that can challenge the revenue line, and that can challenge the overall earnings picture. So that's why here we are in the midst of the earnings season, and we're looking for, particularly where the margin line is concerned, what companies are saying about their outlook. So it's kind of it's an interesting time for a pullback to be expected then.
The fundamentals at Federated are grammed out and coddled. It's really belt and suspenders analysis. Linda, you've led the charge on that. On a factor basis, which factors matter forward? Is it growthiness? Is it momentum? I know that's anathema, but which factors matter in the Dissel universe?
Well, the most important things, I guess, going forward are, can we have the mild economic recession, which we at Federated Hermes have been calling for, and maybe towards the end of this year, just a mild recession, and inflation continuing just to grind down, enough to where Jerome Powell says, I can stop raising interest rates. And so, it's mainly about inflation and the strength of this economy and the resiliency. We keep reading about the resiliency of this economy. We still have a lot of money flowing through the system. That is a challenge for inflation. We need to have that roll through. We need to have unemployment rise, but not too much. So it's kind of more of a balancing act of all these things. And as we all know, the Fed in their tightening campaigns historically were unable to give us a soft landing. Maybe
Linda,
we get it this time.
Help me understand this soft landing and disinflation story when it comes to top-line revenue growth. This is something Tom's focused on, me as well. When we had inflation, we had guest after guest tell us we live in a nominal world, this is going to be good for top-line revenue growth, and now we have disinflation and we're told this is good for equities, it's good for earnings. Linda, can you tell me the relationship between disinflation and revenue growth, top-line growth at S&P 500 companies?
Well, yeah, sure. Disinflation is something that we're rooting for. Ideally, 2% inflation is Goldilocks inflation. And when it comes down, that's good news. If you're a company, however, you have expenses, and some of the biggest expenses that you have will be your labor expenses. Lots of people, as we know, have been able to get excellent year-over-year wage hikes, the likes of which we haven't seen since the 1970s. And we look particularly at the Atlanta Fed wage tracker, which the last number I saw was in the high fours in terms of year-over-year. You're still seeing employees getting wage hikes. If wage hikes come, as inflation starts to slip, and the revenue line starts to slip on a nominal basis, that's bad news for corporate earnings, which is what we're bidding on when we bid on the stock market. So that's kind of the tough spot for companies, and it's something that happens in every cycle as you get to the farther end of the cycle where expenses are higher and the revenue line starts to slip a bit.
So, Linda, are you backing away from labor-intensive sectors on the S&P?
Well, I wouldn't say necessarily that's to be the case. I would say that it's more of a GARP situation right now in terms of the S&P 500. We do have some favored sectors that we like that are inexpensive, but it's very important to watch company by company. It's a stock picker's time right now who are able to manage their expenses. I wouldn't say any one particular sector I'd avoid because they have a problem there. If I were an employee who was being paid a little bit too much versus what I'm worth, I may be a little bit nervous here because when unemployment starts to rise historically, it goes fast.
Linda, just quickly, final sector right now, favorite, what is it?
Favorite sector, I'm just going to tell you right now, we are seeing the economy potentially get slower. Let's go for those high quality dividend stocks. They are dirt cheap. Nobody likes them right now, and you're going to like them if the Fed does what it always does, which puts us into recession.
Linda Dissel there, a Federated Hermes. Linda, thank you.
God,
with a message for Chairman Powell going into next week.
So. It's your fault, Jerome.
Have you seen our survey here at the Bloomberg, Tom, on the Federal Reserve? This came from Steve Matthews and a team. Ultimately, the average forecast now is for one more call, one more hike next week, and then done for the rest of the year. Let's see if that changes later this summer.
I'm going to go with the done part, and I'm going to go with the use of not cutting rates until whenever it really gets a lot done. It's extremely efficacious to get where you are and then keep rates where you are for 1 meeting, 2 meetings, 3 meetings. That alone will be entertainment into 2024. But the idea of when do they cut rates, I don't have that framed in my mind yet. I just can't see it.
People sort of putting March out there, March next year. But I remember when it was later this year as well. That's the question we're asking, one and done or more to come? Bank of America's Mike Gapin says more to come. BNP Paribas, led by Carl Riccadonna over there, says they are done, one and done. July, that's going to be the last hike of the cycle. This is what he has to say. Decelerating economic activity lagged effects of previous rate hikes, tightening lending conditions in the banking sector, and greater evidence of disinflation will be more prominent in the second half of this year. We're living and breathing the second half of this year right now. In their view, ultimately, it will dilute conviction for further tightening. That's the call from Carl and the team over at BNP.
That's one side of the view, and Greg Bottle follows that up with a pretty cautious view on the equity market as well. I'm going to look at the data. The data here is we've got some data today. Claims, market moving, maybe 4-week moving average into some housing data, existing into housing data next week as well. But the truth is, John, where we are in the calendar, we stagger to the July unemployment report, early July, and then shock of shocks, we hinge on an inflation report. It's out there somewhere.
Summer's going quickly, isn't it?
Summer's going quickly.
Where did Bramo go?
Oh, who knows? I think, well, the truth is, I mean, the cruise, what's amazing about what she's doing is
she doing a cruise?
From
You're
Norway.
serious? She's doing
Norway.
a cruise?
She's always wanted to see Greenland.
Going through the fjords, or what's she up to?
No, I don't think she's doing like the old fjord thing in Norway.
You're saying that's for old people?
She's over like in Greenland and Svalbard, is it? Spitsbergen?
No idea.
She's out with the polar bears walking around.
Just for the record, you're saying that the fjords are for old people?
Yeah, fjords are for, you sit there with a martini in your hand and go, oh, Oslo.
And not get off the boat?
She's going out of Bergen, actually.
Nice. Well, we'll try and find out some more. Is she going to do a phone interview? She's going to call in? From New York, this is Bloomberg.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Only a small percentage of our members are on the ads tier, even with the moves we just mentioned. Nice growth in the ads tier, but still off a small base. And we're really early in terms of paid sharing impacts, including extra member, for the reasons that Greg mentioned. That's going to build up over multiple quarters.
That was Spencer Newman, the Netflix CFO, weighing in on their latest results. Subs coming in way better than expected relative to the median estimate in our survey of analysts going into the earnings report. The outlook for revenue a little lighter. Let's talk about what it's doing to the stock. The stock this morning is negative by about 6% at the moment in pre-market trading. Netflix there down by 6.3%. Tesla making a comeback. There was some disappointment after the close yesterday, but we're only down 3%, Tom, relative to a 135% gain year to date before the numbers came out.
I look at this on a standard deviation basis. We're not going to do the math now. We don't do math on Thursdays. But the bottom line is, John, these are trivial pullbacks and the expectation moonshot we've seen out of both stocks.
And barely making a dent in the S&P 500 this morning. The Nasdaq a whole lot lower, but equity futures on the S&P, we're negative by 0.1% right now. No drama there whatsoever. In the bond market, yields bleed a little bit higher, up 3 basis points, 378.35. Going into data later this morning, Tom, jobless claims about 2 hours away.
Data here into the earnings season, and John, I'm just going to look at levels here right now. I got a Dow close 35,000, SPX rounded up 4,600, NASDAQ 15,008. I guess I'm going to round that to 16,000. These are grudging bids, even when the markets go down. I mean, I don't sense here a giveaway.
We're talking about a market, Tom, that's up by more than 40% year to date on the NASDAQ. And if that's a disappointment, you'd expect that to be down a little bit more than just 0.6%, right, in early trading. I'm not sure what that tells you, but it's something.
What I'm going to do, and I think I can speak for the pros, what the pros do is not only look at the last 6 months, the last year, but where are we pre-pandemic? Geetha Raghunathan is expert at this. U.S. media analyst for Bloomberg Intelligence. Geetha, let me go to what's important. Have you seen Barbie yet?
No, not yet, but I'm looking forward to it. There's actually going to be the double feature. It's Barbenheimer.
Yeah,
this weekend.
Well, there's Barbenheimer and all that. I guess we'll talk about that once we see the box office. I do want somebody emailed in, folks, and yes, there is a Ken surveillance. It's the more solid kind of Ken. You know, it's a different Ken than what you had in the 60s. Geetha, I want to talk about Netflix here. I don't have faith in the profitability stream. They make hits. They succeed at Wednesday. They fail at this, etc. Can you develop a persistent free cash flow? Can you develop a persistent EBITDA off of the creative process of success and failure?
That's a really good question, Tom, and I think they've actually shown us that they can. So, you know, obviously the content business, it is a hit or miss business. It's very unpredictable, as you just kind of pointed out. But if you kind of looked at that report yesterday and you looked at the free cash flow story, I mean, this is a dramatic turnaround in what Netflix has been able to achieve. Look at the operating margin leverage. So we're seeing a lot of operating margin leverage. We're seeing a lot of, you know, free cash flow leverage. And this is exactly what you want a streaming model to kind of look like. So they obviously raised their free cash flow guidance by 40%. And there is going to be a little bit of lumpiness. I mean, we're looking at over $5 billion in free cash flow. And going into 2024, again, we think it would probably be $6 to $6.5 billion in free cash flow. So this is going to be a persistent, growing, sustainable positive free cash flow story for many years to come.
Do they have the ability, do they have the elasticity to raise prices? We saw Peacock, maybe some would say desperate, come up $1. Can Netflix ruin my afternoon and come up $1 or $2 per month?
They absolutely can. So this, at the end of the day, if you just kind of look at the breadth and the depth of content, I think Netflix still is fairly underpriced. They do offer a very compelling value proposition, kind of just looking at the amount of content that they have, and they're going to keep adding to it. And then remember that the labor strikes, while they're not good for the industry as a whole, they actually put Netflix in a little bit of a competitive advantage and a little bit of a sweet spot relative to its peers. Of course, it will be damaged if, you know, or it will be hurt if the strikes prolong for you know, into 2024. But I think relative to peers, we're going to see that they're going to do well, and that's probably going to give them some more pricing power.
Geetha, what did they say about that yesterday?
So what they said, so this is, you know, one thing that I think the key takeaway for me from the earnings report was that this whole password crackdown initiative has definitely got off to a very good start. So execution is good. There is a little bit of a balancing act that they've got to do when it comes to subscriber growth as well as ARPU growth, right? Revenue growth. And so what we're seeing this year, 2023, I think is going to be more of the new member or new subscriber growth. And then as they kind of get that benefit of subscribers, we're going to be able to see them to increase pricing to increase revenue. So I think the revenue growth becomes more of a 4Q and a 2024 story.
To put prices up, you need a decent content slate, a deep catalogue, and a lot in the pipeline. And Geetha, you brought up the writer's strike. What did they say on the call yesterday about when that might bite? How long does this need to go on for before it becomes a big problem?
It's not going to become a big problem for Netflix for a considerable period of time. I mean, we've kind of seen them go through a very similar situation, not exactly the same, but we've seen them, having to deal with a whole shutdown in production during COVID, and they still held up relatively well. So remember, they have some advantages relative to peers because they do have a huge backlog, they have a huge content pipeline. That's because of very long lead-in production times. The other thing that they benefit from relative to their peers is they have a lot of foreign content. So, a lot of content coming from, Spanish language markets, from South Korea. So they've been able to diversify that really well. So they're not necessarily hugely dependent on Hollywood, but of course it will affect them. And I don't think they're going to see any material adverse impacts up until at least the latter half of 2024.
What does the rest of LA media do given the Netflix performance? Are they having meetings today going, who do we merge with?
I mean, this is, media, of course, is under tremendous pressure, Tom. So we're seeing the linear TV business almost on the verge of collapse. And I think, the alarm bells kind of really went off when Bob Iger just spoke a few days ago about how the linear TV assets are really no longer core to Disney's business. I mean, this is something unimaginable, right? So obviously, linear TV is under considerable pressure. The good thing with Netflix is they are the cleanest story in media right now because they are a pure streamer, right? Whereas most of these other companies are having to manage this transition from linear to streaming. So yeah, it's a very, very different problem for all of them. Again, they have to manage a declining linear TV business. They have to show profitability on the streaming side, something that Netflix has managed to do really, really well. So it's going to be very, very hard for the media companies. And as you point out, yes, consolidation is definitely on the cards.
Geetha, let's talk about that a little bit more. Is that consolidation, Disney basically consuming all of Hulu, having ESPN, and keeping Disney Plus? Is that how it all works over at Disney, and the rest is up for sale?
Yeah, so, I mean, yes, in a nutshell, yes. So Disney is definitely going to buy Hulu. There are all indications for that. The price point, of course, we don't know yet, but I think it'll be upwards of $10 billion. And then merge that into Disney Plus. And yes, everything other than ESPN is for sale. That's exactly what Bob Iger has said. But the question is going to be, who's really going to be willing to buy it? Because it's a declining business.
Geetha, one final question that's urgent. Who's going to get Ohtani? I mean, is Ohtani such a media value that the LA Dodgers just pick him up? It's like a no-brainer. Day one, they pay for it?
I really don't. I wish I had the answer to that question. Don't know.
Okay, Geetha, prep up next time. Come on, Geetha.
Geetha, thank you. Geetha Raghunathan there, Bloomberg Intelligence. We'll catch up with her again a little bit later this morning. On earnings from Netflix, Netflix up 62% through the close yesterday. This morning, it's down about 6%. Terrible. TK, we mentioned Hulu. I just brought up my credit card statement.
Here we go. I brought it up. This gets John going, folks. You have no idea.
$82.99.
It's ridiculous.
$82.99.
Ridiculous.
Isn't that insane?
I have YouTube TV, and every single day I look in the house at how no one's watching it, and I'm like, how can I get rid of this?
Nuts.
I'm going off the top of my head, $56.
Just going through it all now, Tom.
Who uses it? Do you use
Paramount, $4.99.
Yeah, add it up.
Yeah.
Makes Comcast 20 years ago look cheap.
Peacock in the mix as well.
Yeah, you're huge,
you know.
I don't get Peacock. The Tots, I'll listen to the Tots on BBC 5.
Peacock, $4.99. That's going up. There you go.
It's an outrage.
It's getting expensive, TK.
Coming back, we'll look at our food bills. The Barbie's expensive.
We need a bundle.
Surveillance bundle.
A bundle.
first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Equities this morning look a little something like this. Welcome to the program. Your S&P, your NASDAQ 100, the S&P 500, negative 0.1%, the NASDAQ down by 0.6%. We'll dig into the NASDAQ and some of the single names behind that move lower in just a moment. This just in from HSBC and Max Kettner, who's been constructive, risk on and right through 2023 so far. He says we extend our constructive stance on risk assets as fundamentals are still supportive. This support is likely to be sustained until late summer. And then, Tom, he's looking for inflation to rise again. And
this is out there. This is in the
perhaps
ether.
a problem lurking there. So let's be clear about this. It's not a perma bear. It's not someone who's been super bearish. It's someone who's been very constructive this equity market all year. And they're saying maybe a little bit more to come through the summer.
I can't cite in the zeitgeist who it was, but a very smart couple paragraphs on it. Also, in October, we have medical cost adjustments, which will be a inflationary pushback against disinflationary tendencies. So maybe that's how you get stability of price or even a little bit of a lift.
Student loan repayments resume too, TK.
Yeah.
It's just on the calendar. It's on the horizon.
It's marginal.
I'm with you.
I agree on that. I mean, we're not going to go through all the earnings right now. These guests are too important that we have in the next 30 minutes for you. But, we're seeing J&J. I mean, we'll get to it. I mean, thumbs up. United, thumbs up.
D.R. Horton, home builder, numbers just now.
I mean, there's a little bit of thumbs up.
EPS, 390, the estimate. 283 revenue, 9.73 billion the estimate, 8.36. Upside surprise there for D.R. Horton just moments ago. Let's turn to the bond market just briefly. 2-year, 10-year, 30-year. The 2-year looks like this. Yields up 4 basis points, 480. The 10-year looks like this. Yields up 3 basis points, 378. But that curve, Tom, has got inverted again down to negative 102. Negative 102 this morning.
Just right through 103
Deep
is what
inversion.
I'm seeing. Yeah, 98, 99, and further an inversion down. So that's important here to mix as we wait for the data in 2 hours.
Let's follow forward, throw it forward, push it forward into the euro and the FX market. The euro looks like this. Had that big, long winning streak on euro dollar. Snapped that earlier in the week. Still clinging to 112, or 112.10 at the moment on that currency pair. We're negative by 0.1%. Just want to turn to the single names out there at the moment, Tom. We talked about a few of them, Netflix and Tesla. Netflix at the moment down by 6%. Subs were pretty decent, tidy. The outlook for revenue, a little weaker though. That name is struggling. Not struggling year to date, struggling on the session. Year to date is still up by 62% before today's move. Tesla chasing volume over profit. Elon Musk is not shying away from that. The name is down by about 2.9%. Just in terms of inventories, they're ticking higher. We're going to talk about that later in the program. Just a bit softer there, but relative to what? Relative to a 135% move year to date on that name. And here's another one, Tom. It's an airline. United is up by 2.9%.
Yeah.
United Airlines liking what it sees for international travel. TK, I think many people listening to this show right now living it.
I have a relationship with United Airlines. I want to be clear about that. But Scott Kirby sent me a love note, I think 18 hours ago, They are rapidly expanding across the Pacific Ocean. It's something literally out of the 60s or 70s. I can't remember all the names, Hong Kong, Tokyo.
LA to Hong Kong, I think, from October, yeah.
Yeah, I mean, they're adding flights as part of what we see there, even with the travails at Newark EWR that we see each and every...
Not a Newark fan. I know you like United. I know you fly with them,
I'm not a Newark fan. It's just the choice I have. No, I'm not a fan. That's the choice.
That you'll go from Manhattan all the way round.
It's better than O'Hare. That's how I look at it.
Okay. Let's get to that FX market. Eric Nelson of Wells Fargo saying he's inclined to fade the recent dollar weakness. Here's the quote. I'm skeptical this is the beginning of a more prolonged cycle of dollar weakness. For the dollar to weaken much more from here, I think you need to see the US labor market deteriorate rapidly and or see global growth prospects improve materially. That's the pushback from Wells Fargo this morning, Tom.
Eric Nelson writes careful notes. He's the macro strategist at Wells Fargo and joins us this morning. I want to go down the page, Eric, away from the majors. You've got a beautiful set of paragraphs on what the adults look at. It's actually how I met young John Farrow 5 or 6 years ago, and that is strong Swiss franc. What does strong Swiss franc indicate about the foreign exchange continuum?
Well, I think there's two things to consider here, Tom. For one, you have the Swiss National Bank is very actively buying this currency. They are not shy about it. They'll tell you first thing. And so that's really been driving some significant overvaluation in the Swiss franc. And what's also strange is risk on, risk off, equities down, equities up, commodities. It doesn't matter. Swiss franc keeps getting stronger. At this point, I think it's come too far, too fast. You look at the balance of payments data, you look at kind of how strong fundamentals are in the global economy right now, especially, considering the risk-on environment. I want to fade this Swiss franc strength, and I like to do it against the euro and the U.S. dollar.
How does it change your analysis that a given central bank maybe acts like in the textbooks? It's in Steve Cicchetti's textbook and the rest of them. And the Swiss National Bank has something like $90 gazillion in Apple, Alphabet, and the rest. Does that change your analysis that they're running a sovereign wealth fund within the bank?
Well, I think that they're certainly keen to sort of downsize some of the massive portfolio expansion they've seen in the past 10, 15 years. And of course, that's part of the other side of the equation of FX intervention. But I kind of think about the inflation target for the Swiss National Bank, 2% actually being a ceiling. They're pretty much the only central bank in the G10 that's actually achieving their inflation target. And that's really key, in my opinion, in terms of shifting their balance of risks, in their opinion, about where the Swiss franc is. I think they're starting to get more comfortable with how much strength they've seen and might start to ease up a little bit.
Within your dollar resiliency call, is broader FX tradable like BBDXY or DXY? Are they tradable, or are there certain pairs where you can get big figure moves?
Well, look, dollar yen is going to be really interesting into the meeting next week. And there's some excitement about Ueda's speech earlier in the week, and maybe that it's a signal the BOJ is not going to do anything, so you see dollar yen trickling back higher. But really what we've seen ahead of the last 2 or 3 meetings, the Bank of Japan has actually explicitly, via the media, signaled they're not going to do anything. We haven't heard that yet. So to me, next week is still live, and there's still potential for big vol in either direction in dollar yen.
Eric, real quick here. Farrell wants to get in. He's looking at me like Bramall looks at me in the middle of an interview. Eric, does it matter that Mr. Ueda has major English skills, Western educated in that versus Kuroda? Is the analysis different because Ueda's day-to-day psychologically more accessible?
Well, certainly we saw this earlier this year, Tom, right, in terms of some of the difference in the Japanese language and English language communications, this shift from persistent to patient monetary easing. That's an important shift, right? The BOJ doesn't often change anything in their language, so you want to focus on it when they do. And so I do think there's still potential for more changes to policy. The question for me is, what are those changes? If they're going to move yield curve control from the 10-year to the 5-year, how much sustained yen strength are we going to see? And, is that something you just want to fade once you get the initial knee-jerk move?
So, Eric, let's put a bow on it. The ultimate view, the base case for you, you just don't buy what the dollar bears are trying to sell. What are they getting wrong?
Well, it's twofold, John. I think one is the extent of Fed cuts that are priced. Look, I think it's completely realistic that we'll be in a U.S. recession maybe later this year, early next year. I know it keeps getting pushed out, but the extent of tightening, at some point we do think the recession is going to come. But to see 150, 200 basis points of cuts price for the U.S., given where the labor market is, I think that there's room for that to be reduced. And then I also look at the growth picture. Europe, China, really just not inspiring me. And the policy easing we've seen from China thus far, I know we have Politburo next week, but thus far has been pretty underwhelming. Whereas in the U.S., growth is good enough, I think, to keep the dollar on pretty solid footing here.
So, Eric, let's talk about inflationary trends as well, not just growth trends. I spoke to someone recently that expects inflationary trends, regionally speaking, to diverge. Are you saying they converge, they diverge? What are you expecting, Europe, UK versus US, when it comes to price pressure?
Well, I think for Europe, there has obviously been a significant softening and underlying pressure. Whereas in the UK, yes, we've come off a little bit, but I do think that it's still at 6.8, 6.9%. That's pretty high. The question for me is really, what's the Bank of England going to do about it? They've been very hesitant to really step up and have really been being led by the market. So I think they're going to downshift to 25. And I do start to worry more about inflation expectations, market-based in the UK. That, to me, is one of the most important indicators you need to watch here over the next few months, particularly given the fiscal situation in the UK.
Well, I'm asking for a friend. Ban sterling for us. What's cable going to do here? Give me a point.
Well, Tom, I think the trade you want to be in for a longer period of time, 3 to 6 months, is being long euro against sterling. But I do think that in the short term, the next few weeks or so, really because of how far dollar weakness has gone, I think cable has another couple big figures to run here, 125 to 126. At that point, maybe people reassess. I think the carry story maybe supports sterling for a little bit longer. But I do think that longer term, the euro sterling higher story makes sense over a few months.
John, that doesn't get us out to Arsenal Tottenham. I mean, I can't do a tradable thing there.
You're looking for a weaker pound for that.
I want to get a better cigar at the Lanesboro, but I don't think I can do that off that trade that Eric's arbitrage.
125. You want it lower than that?
I'm trying to arbitrage a really decent cigar at the Lanesboro, and I just don't think I can do it with that trade.
Okay. Eric Nelson of Wells Fargo. Eric, thanks for that. Pushing back against the gloom around the US dollar.
I need 123.
Looking for some dollar strength, looking for a move from 130 down maybe to 125 against the pound. Can we return to D.R. Horton, the home builder? This home builder in the United States year to date is up more than 40%. It's up another 8% in the pre-market. Tom, they've come out with earnings. It's beat. 390 versus 283 on EPS. Revenue close to 9.7 billion. The estimate 8.6. That's a monster upside surprise. And then the outlook. They see full-year revenue, here's the range, 34.7 billion to 35.1. Previously, they'd seen 31.5 to 33. Tom, we're talking about a big beat and a big raise for a home builder in America. At the same time, we're seriously having conversations about the prospect of recession. It's that odd in this economy right now.
And this is where, you don't know when they're going to go, and you get some macroeconomics, or in this case, housing dynamics to make it pop. But we forget, we're so focused, and folks, I am as guilty of this as anyone. Apple, name 4 other, Tesla, Netflix, whatever. Boring D.H. Horton, up 21% per year over the last 10 years. Nobody talks, their tickets to the Texas Rangers are outstanding. Other than that, who talks about D.H. Horton? They're up Apple-like, and they get none of the love. This is a really important lesson.
Who would have guessed that 5% interest rates from the Federal Reserve would support this name, not hurt it? Who would have guessed that? Based on the fact that rates are now so high that if you have 2-3% over 30 years, you're not moving. So basically, we've strangled, suffocated supply in housing in America. And all the home builders are loving it. Look at these numbers. The outlook for homes closed, 82,800 to 83,300. Previously, the range was 77 to 80K.
Yeah, I'm going to defer to Bloomberg Intelligence on this, someone like Jay McCandless at Wedbush. But the bottom line is they're also servicing the upper decile or upper quintile of America that clearly is prospering amid this 2% GDP. In hindsight, it's a great story, but I really take issue with the myopia we have of focusing on exactly 7 names. This is and Bramo does this better than you and me. We're pretenders.